Hello there and welcome to History for Lunatics. I'm so glad you're here tonight. Pull up something comfortable, maybe a blanket, maybe a warm drink, maybe just the quiet corner of the room where the day finally stops asking things from you, because tonight we're going somewhere that does not look frightening at first. Not to a battlefield, not to a prison, not to a burning city, not to a trading floor where men are shouting into telephones and numbers are falling so fast that no one can write them down. We're going to a bank, a small one. The kind of bank that used to sit on the corner of an American town with clean windows, a brick front, a flag outside, and a sign promising safety in letters so ordinary that nobody thought twice about them. A place with pens chained to the counter, calendars with pictures of farms or smiling families, a bowl of hard candy near the teller window, and a vault door in the back that made the whole building feel stronger than it really was. And here is the strange thing about the story we are about to enter. The crisis did not begin with masked robbers. It did not begin with depositors pounding on locked doors. It did not begin with a single terrible morning when everyone suddenly understood that something had gone wrong. It began quietly, with interest rates, paperwork, real estate deals, friendly handshakes, political promises, and a dangerous little belief that money insured by the government could be risked by private men while ordinary Americans slept peacefully, thinking their savings were safe. Before we go any further, let me ask you something. Where are you listening from tonight? Are you in a bedroom with the lights low? Are you at a desk after a long day? Are you somewhere in the world where the banks look different but the feeling is still the same? That small private feeling we have when we put money away and hope it will still be there when life asks for it. Because that is what this story is really about. Not only banks, not only laws, not only a financial scandal with numbers so large they almost stop meaning anything. It is about trust. The kind of trust that sits inside a passbook, inside a mortgage payment, inside the small envelope of cash a retiree carries to a teller on Friday morning. It is about the feeling that if you save carefully enough, if you behave responsibly enough, if you do not gamble with your own life, then the institutions around you will not gamble with it either. And if this kind of storytelling speaks to you, if you enjoy history told slowly, with the ordinary people left inside it instead of swept away by the big words, it would mean a great deal to me if you hit that subscribe button and give this video a like. You do not have to do it right now. Do it when you feel it. When something in this story makes you pause for a second and think about the world a little differently. And if you want to tell me where you're watching from tonight, I genuinely love reading those comments. It makes this whole strange little history room feel a little less empty. Now, let us go back. Not all the way to the collapse yet. Not yet to the failed thrifts, the government auctions, the burned condos, the angry hearings, or the bill handed to taxpayers after the people who made the deals had already walked away. Let us begin in the safer world before the trouble became visible. Picture America in the decades after the Great Depression and World War II. A family walks into a savings and loan association. That name sounds a little old now, almost quaint, like something painted on a wooden sign above a hardware store. But for much of the 20th century, savings and loans were among the most familiar financial institutions in American life. They were not supposed to be glamorous. That was the point. They were not Wall Street. They were not investment banks. They were not places where people speculated in foreign bonds or oil futures or complicated paper that only a few men in a back office pretended to understand. A savings and loan, often called an S&L or a thrift, was supposed to do something very simple. It took savings from ordinary people in the community and used those savings to make home mortgage loans to other ordinary people in that same community. A person put money in. Another person borrowed money to buy a house. The institution sat in the middle, modestly, safely collecting interest, paying interest, keeping the town moving. By 1980, federal insurance covered roughly 4,000 state and federally chartered savings and loans with total assets of about $604 billion. Most of those assets were still tied to traditional mortgage investments, which tells you how deeply the industry had been built around the American home, There is something almost touching about the old thrift model when you look at it from a distance. It was built around one of the most ordinary dreams in American life, the dream of the little house, not a mansion, not a gated estate, just a place with a front step, a kitchen window, a bedroom for the children, maybe a garage if things were going well, and a patch of lawn that needed mowing every Saturday. The savings and loan industry grew around that dream. It helped turn local deposits into long-term mortgages. It helped make home ownership feel like a ladder a working family could actually climb. For decades, that was its identity. Slow money, local money, boring money. And boring in finance can be a beautiful word. Boring means the lights stay on. Boring means your grandmother can walk in with a passbook and walk out feeling sure that the numbers written inside it mean something. Boring means nobody at the bank is bragging about doubling assets in 2 years, or flying to a resort to talk about development deals in the desert. Boring means the banker knows the borrower, knows the neighbourhood, knows the value of the house, knows that a family is not just a line on a balance sheet. But even boring systems have weak points, and the weak point inside the old savings and loan world was hidden in the very thing that made it seem so stable. These institutions borrowed short and lent long. That sounds like one of those dry financial phrases that belongs in a textbook, but it is actually very simple. The money that depositors placed in savings accounts could move. People could withdraw it. They could demand higher interest. They could take it somewhere else. But the mortgage loans made by savings and loans lasted for decades, often at fixed interest rates. If an S&L made a 30-year mortgage at 6%, that loan sat on its books paying 6% year after year. As long as the institution could pay depositors less than that and operate calmly, the system worked. It was not exciting, but it worked. The trouble came when the world around that simple arrangement changed faster than the old system could handle. By the late 1970s and early 1980s, inflation had torn into the American economy like a leak in the roof that nobody could patch quickly enough. Prices rose, wages strained to keep up. The Federal Reserve pushed interest rates very high in an effort to break inflation. Suddenly, the old thrift model was in pain. Savings and loans were still earning relatively low interest on old fixed-rate mortgages, but they now had to pay much higher interest to keep depositors from moving their money elsewhere. Imagine you own a small store, and you bought your inventory years ago at one price. But every day the cost of keeping the store open rises beyond what your sales can cover. That was the basic squeeze. The FDIC's historical review explains that many S&Ls were losing money in the early 1980s because of rising interest rates and the mismatch between their long-term assets and short-term liabilities. Net income for FSLIC insured S and Ls fell from a positive $781 million in 1980 to losses of $4.6 billion in 1981 and $4.1 billion in 1982. Now, this is where the story could have gone one way and instead went another. A banking system under stress can be handled carefully. Regulators can close weak institutions early. Losses can be recognised while they are still small enough to manage. Owners can be forced to raise capital, merge, shrink, or leave the business. That is painful, but pain taken early is sometimes what prevents disaster later. In the savings and loan crisis, much of the pain was postponed. And postponed pain does not disappear. It grows interest. It waits in the walls. It becomes more expensive every year that no one wants to open the door and look at it. At the start, many people wanted to believe the problem was temporary. That is understandable. Nobody likes to believe an entire industry is in trouble. Nobody likes to admit that institutions carrying the word savings in their name might be insolvent. And the word insolvent itself has a cold, clinical sound to it, as if it belongs to accountants and examiners, not to families standing at teller windows. But insolvency means something brutally simple. It means the institution does not really have enough value to cover what it owes. The building may still be open, the tellers may still smile, the advertisements may still run in the newspaper, the president of the association may still belong to the Rotary Club and shake hands at the 4th of July parade. But beneath the carpet and the polished counter, the numbers are wrong. One of the most dangerous things about banking is that a bank can look alive after it is already dead. A factory in trouble may show it plainly. The machines stop. The workers are sent home. The windows darken. A farm in trouble shows it in the fields. The crop fails. The animals are sold. The barn roof sags. But a financial institution can continue for a while on appearances, especially if depositors are protected by insurance and regulators are reluctant to act. The doors open at 9. The vault is still there. The cheques still clear. Coffee is still served in the lobby on Customer Appreciation Day. And if the institution is already insolvent, its managers may face a temptation that is almost perfectly dangerous. If they operate conservatively, they are dead. If they gamble and win, they might survive. If they gamble and lose, the losses may fall not only on them, but on the insurance fund and eventually on taxpayers. That is the dark little engine inside this crisis. It is the reason a failed thrift could become more dangerous, while still appearing normal from the sidewalk. This was not simply a story of bad luck. High interest rates hurt the industry badly, yes, but the damage that followed was shaped by decisions. In 1980 and 1982, Congress passed major banking laws meant in part to help financial institutions compete in a changing world. The Depository Institutions Deregulation and Monetary Control Act of 1980 and the Garn-Saint-Germain Depository Institutions Act of 1982 gave thrifts new powers, loosened older restrictions, and changed the rules in ways that were supposed to make survival possible. But in practice, these changes gave some weak institutions room to grow instead of forcing them to heal. The FDIC's history says these early 1980s legislative actions were designed to aid the S&L industry, but increased the eventual cost of the crisis. The 1980 Act reduced net worth requirements, and the 1982 Garn-Saint-Germain law wrote capital forbearance into law. Let us sit with that phrase for a moment. Capital forbearance. It sounds dry enough to make your eyes slide away from the page. But inside that phrase was one of the most important permissions in the whole disaster. It meant regulators could allow troubled institutions to keep operating, even when their real capital position was dangerously weak. It meant time was being granted. It meant people were hoping the economy would improve, interest rates would fall, real estate would recover, and the institutions would grow their way out of trouble. Hope is a very human thing. It is also a very dangerous banking strategy when it replaces discipline, and then came the money. Because once thrifts were allowed to pay higher rates and operate with loosened rules, deposits began to flow toward the institutions willing to promise the most. This is where the story starts to leave the quiet passbook world behind. The old neighbourhood savings and loan had depended on local depositors, the same people who came into the lobby, who knew the tellers, who recognised the manager in the grocery store. But by the 1980s, money could arrive through brokers from far away. A troubled thrift did not need to persuade only the people in town. It could attract deposits from across the country by offering higher interest rates, and those deposits were insured, which meant many savers did not have to think very hard about whether the institution itself was healthy. If the rate was better and the deposit was insured, the money could move. This changed the character of the business. A savings and loan that had once grown slowly through local relationships could suddenly swell with brokered deposits, and use that money to fund projects far beyond the old pattern of home mortgages. Office towers, shopping centres, raw land, resorts, condominiums, speculative construction in regions where real estate seemed only to rise until it did not. The Federal Reserve's history describes how, from 1982 to 1985, thrift industry assets grew 56%, more than twice the growth rate of banks, with deposits flowing into weak, zombie thrifts that paid high rates and pursued increasingly risky projects in a go-for-broke strategy. That phrase, zombie thrift, is ugly, but it fits. These were institutions that should have been dead or restructured, but continued walking around, taking in money, making loans, growing larger, and in some cases becoming more reckless precisely because they were already beyond ordinary caution. A healthy institution has something to lose. Its owners care about preserving capital. Its managers know that a foolish loan can damage a real business. But a deeply insolvent institution can become strange. It can begin to act like a man who has lost so much at a card table that he no longer thinks in ordinary numbers. A modest win will not save him. A careful hand will not save him. So he pushes more chips into the centre, not because the odds are good, but because the small responsible choices are no longer enough. Now picture the ordinary saver in the middle of all this. Not a regulator, not a developer, not a senator receiving calls from a wealthy donor. Just a person with savings, maybe a retired schoolteacher in Arizona, maybe a factory worker in Ohio, maybe a couple in Texas who sold a house and wanted to park the money somewhere safe before buying the next one. They see an advertisement. The thrift is paying more than the bank down the street. The deposits are federally insured. The lobby looks respectable. The person behind the desk is friendly. There is no warning bell. There is no smell of smoke. The saver hands over the check. The money goes into the system. And somewhere far away, perhaps, it helps fund a loan for land that has been appraised too generously, or a development planned by someone with more confidence than judgment, or a deal arranged by people who understand that if it fails, the full damage may not land on them. This is why the savings and loan crisis feels different from some other financial disasters. It wore the clothing of respectability for a long time. It did not look, at first, like gambling. The men involved often used the language of growth, modernization, opportunity, free enterprise, local development, community progress. There were ribbon cuttings, there were brochures, there were drawings of buildings that had not yet been built, with trees and fountains and sunlight carefully placed by the artist. There were appraisals stamped and filed. There were loans approved by boards that sometimes had every reason to ask harder questions and did not. There were regulators who saw trouble but lacked money, authority, staffing, or political backing to stop it quickly enough. The FDIC's review noted that the old S&L supervisory system had been built for a simpler industry and was not ready for the complex new environment of the 1980s when thrifts had new powers and examiners were understaffed, undertrained for the changed industry and limited in resources. I want to be careful here, because not every savings and loan was crooked. Not every manager was reckless. Not every borrower was dishonest. Many thrifts were run by people who tried to survive an impossible economic squeeze and did not enrich themselves at public expense. Many employees working inside these institutions had no control over the decisions being made above them. The teller at the window did not design deregulation. The loan clerk did not create the interest rate shock. The bookkeeper did not decide whether a troubled institution should be closed or allowed to limp forward. Financial crises have a way of turning ordinary workers into the visible faces of decisions they never made. When the doors finally close, it is often the lowest paid person in the building who has to tell the customer they do not know what happens next. But there were also frauds. There were conflicts of interest. There were insiders who used federally insured money as if it were a private hunting license. There were developers who found that owning or influencing a thrift could make financing easier. There were men who treated the institution not as a guardian of savings, but as a machine for turning public protection into private opportunity. The old line between banker and borrower blurred in dangerous ways. Money went out, land was bought, projects rose half-finished from the ground. In some places, especially where real estate fever and oil booms had fed each other, the landscape itself became part of the evidence. Empty subdivisions, unfinished condominiums, office buildings without enough tenants, roads leading to developments that never became communities. Texas became one of the great centers of the meltdown. That was not an accident. It had oil, land, rapid growth, speculation, and then a regional bust that exposed the weakness of deals built on rising prices. The Federal Reserve's history notes that Texas was the epicenter of the thrift industry collapse, and that in 1988, the peak year for FSLIC insured thrift failures, More than 40% of thrift failures and assisted transactions nationwide had occurred there. There is one detail from that period that sounds almost too strange to be real, and yet it is real enough to stop you when you read it. In 1987, the insurance fund decided it was cheaper to burn some unfinished Texas condominium units financed by a bankrupt S&L than to try to sell them. Think about that image. A financial crisis turning into a literal fire. Buildings that had existed first as promises on paper, then as loan documents, then as half-built shells, finally reduced to smoke because the numbers no longer justified leaving them standing. That is the kind of image history gives us when it wants to make sure we understand. The crisis was not only numbers, it was physical. It had addresses, it had drywall and concrete, it had empty lots and auction signs, it had office furniture stacked in failed branches, it had regulators walking into buildings where everyone already knew the end had arrived but still kept their voices low. It had elderly customers reading newspaper headlines and wondering whether the government insurance promise would hold. It had honest thrift managers watching dishonest competitors pay higher deposit rates because the dishonest ones no longer cared about the future. It had communities where the bank on the corner, the place that had once helped families buy homes, became a symbol of something harder to forgive, the discovery that safety can be used as cover for risk. And underneath all of this sat the insurance fund itself, the Federal Savings and Loan Insurance Corporation, or FSLIC. It had been created during the New Deal era to ensure savings and loan deposits, much as the FDIC insured bank deposits. In ordinary times, deposit insurance is meant to prevent panic. It tells the public that small depositors do not need to run to the bank at the first rumour of trouble. That promise matters. It helped stabilise American finance after the terror of Depression-era bank runs. But deposit insurance also creates a danger if the people controlling insured institutions are not supervised strictly. If depositors believe the government will protect them, they may stop asking whether the institution is safe. If managers know deposits will keep coming because they are insured, some may take risks they would never take if customers were watching closely. This is the moral hazard at the heart of the crisis, and though the phrase sounds academic, the idea is very old. If someone else will absorb the worst losses, reckless people become braver. By the late 1980s, the problem could no longer be hidden behind patience and accounting. The FSLIC itself was overwhelmed. The number of failed institutions and the size of the losses had outrun the system built to contain them. Congress finally stepped in with major reform. In 1989, the Financial Institutions Reform, Recovery and Enforcement Act abolished the old Federal Home Loan Bank Board, and the bankrupt FSLIC created new oversight structures, placed thrift insurance under the FDIC, and established the Resolution Trust Corporation to close and clean up failed savings and loans. The RTC eventually closed 747 S&Ls with assets of more than $407 billion, and the ultimate taxpayer cost has been estimated as high as $124 billion. Those are large numbers, and large numbers can make a story feel distant. So bring it back down to the counter. Bring it back to the person with the passbook. Bring it back to the family that believed the thrift was conservative because it always had been. Bring it back to the retiree who did nothing wrong, whose money was protected, yes, but whose faith in the people behind the polished desk was not so easily restored. Bring it back to the taxpayer who never made a risky loan, never approved a speculative development, never lobbied for looser rules, never collected profits during the good years, and yet helped pay the bill when the bad years arrived. That is why the savings and loan crisis mattered. Not only because institutions failed, but because it revealed something Americans have had to learn again and again in different forms. When private risk is wrapped in public guarantees, the line between someone else's gamble and your own life can become very thin. The bank on the corner stopped feeling safe not all at once, but gradually, the way trust often disappears. First, there were stories in the business pages, then stories on the evening news, then names of failed thrifts, then photographs of regulators entering buildings, then congressional hearings, then men in suits saying they had followed the rules as they understood them. Then ordinary Americans trying to understand how an industry built to finance homes had ended up financing so much ruin. And if we are going to understand how that happened, we need to return to the beginning of the savings and loan itself, before the crisis, before the reckless growth, before the word thrift became attached to scandal, when these little institutions were meant to be the safest places in American finance, and when their whole purpose was not to gamble with the future, but to help a family open the door to a house and call it their own. Before the word thrift became attached to scandal, before men in expensive suits used savings and loan associations as engines for real estate speculation, before regulators had to step into ruined institutions and sort good paper from garbage paper, these little savings banks had a very different place in American life. They were not supposed to be clever. They were not supposed to be fast. They were not supposed to make anyone rich overnight. In fact, the best thing you could say about a savings and loan for most of its history was that nothing exciting happened there at all. The front door opened in the morning. The teller counted deposits. The loan officer reviewed mortgage papers. A young couple came in nervous and hopeful, trying to buy their first house. An older woman came in with a passbook, checking that the interest had been written neatly on the next line. The manager knew who had lost a job, whose son had come home from the service, whose farm was struggling, whose new baby meant they might need another bedroom. This was not banking as spectacle. This was banking as routine, and routine was exactly what made people trust it. To understand why the savings and loan crisis hurt so badly when it finally came, you have to understand what these institutions had once promised. Not in legal language, not in advertising language, but emotionally. They promised that savings would stay close to home. They promised that $1 deposited by one person in town might help another person in town buy a roof, a porch, a kitchen, a little square of stability. They promised that finance could be local and practical, not distant and mysterious. The early idea was almost plain enough to explain at a kitchen table. A group of people pooled their money. One member borrowed from the pool to buy a home. That member repaid the loan, and then the money could be lent to another member. It was slow, but it had a moral shape people could understand. The first American savings and loan is usually traced to Pennsylvania in 1831, when townspeople in Frankfurt organised the Oxford Provident Building Association, so members could help one another become homeowners. The OCC notes that by 1893 there were nearly 6,000 such institutions in the United States. Think about what that meant in the early 19th century. A house was not simply a purchase. It was the largest claim most ordinary families would ever try to make against the future. In a world without the modern mortgage system, without a 30-year fixed loan available from a bank down the street, home ownership could be difficult for people who were not already comfortable. Early commercial banks were often not in the business of lending to ordinary families for residential mortgages. They were built around commerce, trade, business credit, short-term obligations, the movement of goods and money through a growing country. A family wanting a home had fewer options. So building associations and later savings and loans stepped into that empty space. The Federal Reserve's history describes the first S&Ls as groups of people who wanted to buy homes but lacked the savings to purchase them outright, pooling savings and lending the money back to members for home purchases. There is something almost intimate about that arrangement. It did not begin as a giant industry. It began with people who understood that one family could not do it alone, but many families together might be able to do it one at a time. The name building and loan tells you what mattered. Building came first because the house was the point, the loan was the tool, and in that older world a savings and loan was tied to the rhythm of a neighbourhood in a way that later finance would become too large to notice. The institution did not need to invent a market thousands of miles away. It did not need to chase a yield in securities no depositor had ever heard of. It needed savers, borrowers, houses, repayment, patience, and confidence. Those are not dramatic ingredients, but for a long time, they were enough. By the early 20th century, these institutions had become part of the American housing system. They carried different names in different places: Savings and Loan Association, Building and Loan, Homestead Association, Cooperative Bank, Thrift. The names varied, but the basic identity remained recognizable. They gathered savings from individuals and used those funds to make long-term loans, especially residential mortgage loans. They were usually smaller than commercial banks and more specialized. That specialization made them seem safer to many ordinary people. A commercial bank might serve merchants and businesses and handle a variety of loans. A savings and loan was associated with the home, and home, in American life, carried a power that was more than financial. It meant respectability. It meant arrival. It meant that the family had a place to put the piano, the crib, the Christmas tree, the good dishes, the framed photograph of a son in uniform. It meant the landlord's knock no longer decided the shape of your life. The Great Depression nearly destroyed that confidence. In the early 1930s, foreclosure signs, failed banks, and broken household finances turned the American home into one of the most painful symbols of the crisis. Families who had believed they were secure found that security could vanish. People lost jobs, missed payments, watched lenders demand money no one had, and saw houses sold from underneath them. Financial institutions failed in great waves. Savings institutions were not spared. The old local model could not protect itself from an economy collapsing around it. So the federal government stepped in and built a new structure around thrift finance. The Federal Home Loan Bank Act of 1932 created the Federal Home Loan Bank system to provide liquidity and low-cost financing for S&Ls. The Homeowners Loan Act of 1933 allowed the Federal Home Loan Bank Board to charter and regulate federal savings and loans, and the National Housing Act of 1934 created the Federal Savings and Loan Insurance Corporation to insure thrift deposits. That structure mattered because it did more than create agencies. It wrapped the thrift industry in a public purpose. The government wanted stable mortgage credit. It wanted families to be able to buy homes. It wanted local institutions to survive so they could keep making loans. It wanted depositors to trust that their money would not vanish if rumours started in the street. Deposit insurance was especially important. Anyone who remembered the bank runs of the Depression understood what fear could do. A rumour could become a line outside the door. A line could become a panic. A panic could destroy even an institution that might otherwise have survived. Insurance told the small saver not to run. It said, in effect, your money is protected up to the legal limit. You do not have to be an expert in the bank's books. You do not have to stand in the cold at dawn waiting to withdraw your savings before your neighbour does. In the safe years, this arrangement seemed to work, not perfectly. No financial system is perfect, but it worked well enough to build habits of trust. The savings and loan was where a family opened an account for a child. It was where wages slowly became a down payment. It was where a couple could sit across from a loan officer and learn whether the house they had been driving past for 3 weeks could actually become theirs. The passbook itself became a small object of reassurance. You brought it to the teller. The teller stamped or wrote the transaction. The numbers lined up. The savings grew. There was something solid in that little booklet, even though the money itself had already been transformed into loans and claims and obligations inside the institution. The passbook made finance feel visible. It gave trust a cover and pages. I want you to picture one of these places around 1955. The building is modest, maybe 1 story, maybe 2. It is not trying to intimidate anyone. The glass door is painted lettering. Inside there is a counter, a few desks, a vault, framed certificates on the wall, maybe a clock that ticks loudly because the lobby is quiet. The people waiting are not speculators. They are customers. A man in work clothes deposits part of his paycheck. A woman asks about a Christmas club account, one of those special savings accounts that helped families put aside money during the year so December would not arrive like a bill collector with tinsel. A young veteran and his wife ask about mortgage payments. The manager knows the houses being discussed because he has driven past them. He knows the builder's reputation. He knows whether the street floods after a hard rain. He knows the borrower's employer. This local knowledge was not a perfect substitute for sound underwriting, but it was real, and in a slower, more local market, it meant something. The loans themselves were meant to be conservative. A thrift did not exist to finance wild ventures. It existed to finance homes, especially single-family homes. The money came in from depositors, and much of it went back out as mortgages. In the decades after World War II, as suburbs expanded and home ownership became central to the American middle-class story, savings and loans became major conduits for mortgage credit. At their height, savings institutions originated 2/3 of the nation's home mortgages, according to the OCC's History of the Federal Thrift Charter. By 1980, just before the crisis fully revealed itself, there were almost 4,000 thrifts with about $600 billion in assets, and roughly $480 billion of that was in mortgage loans, representing about half of all outstanding home mortgages in the country. Those numbers are large, but the important thing is what they show about the industry's identity. The thrift was not a minor side street in American finance. It was one of the main roads to home ownership. When an industry touches the home, it touches memory. It touches family formation. It touches where children go to school and where people expect to grow old. This is why the later betrayal felt so personal. A scandal in some distant securities market may anger people, but a scandal in the institutions built around home savings feels like something has entered the living room without permission. For decades, thrift regulation encouraged this narrowness. The old rules limited what savings and loans could do. They were expected to focus on mortgage lending and household savings. Their business model depended on a simple spread. They paid depositors one interest rate and earned a higher rate on mortgage loans. That spread, if managed properly, covered expenses and produced enough profit to keep the institution alive. It was not a path to sudden wealth. It was more like a mill wheel turning slowly as long as the water kept moving. The wheel did not need excitement. It needed consistency. Even the competition for deposits was controlled. After the Depression, federal law and regulations limited the interest rates banks could pay on deposits, a system known as Regulation Q. The idea was that excessive competition for deposits had contributed to instability in the 1920s, encouraging institutions to chase income in unsafe ways so they could pay higher rates. The Federal Reserve's history explains that interest rate controls were introduced in the 1930s, partly to prevent excess competition, and similar controls were later extended to insured savings and loans in 1966 after a credit crunch threatened mortgage markets. For ordinary savers, this meant the rate at one institution might not be wildly different from another. For thrifts, it meant they could often hold on to retail deposits without having to bid aggressively in a financial arms race. That controlled world produced its own strange little customs. Banks and thrifts competed around the edges, not always with raw interest rates, but with convenience, friendliness, gifts, and familiarity. The Federal Reserve notes that institutions sometimes use non-rate inducements like free gifts, including toasters and umbrellas, as ways to attract depositors when direct interest competition was restricted. That detail may sound funny now, but it says a great deal. Imagine a banking world where a toaster is part of the battle for savings, not derivatives, not brokered deposits flying across the country. A toaster, an umbrella, a wall calendar, a smiling teller who remembers your name. It seems almost innocent in retrospect, though of course no financial system is ever truly innocent. But compared with what came later, it was a slower and more contained form of competition. There was a social contract hidden inside that containment. Small savers accepted modest returns, thrifts accepted limited powers. Regulators accepted the industry's public mission. Home buyers received mortgage credit. The system was protected partly because it was fenced in, and fences matter. A fence can feel restrictive when everything is calm. People complain that it limits freedom, blocks innovation, prevents growth, keeps ambitious men from doing ambitious things. But a fence around insured savings also keeps the cows out of the road, if you will forgive the homely comparison. It tells the institution, this is what you are for, and this is what you're not for. You may be dull, but you will also be useful. For a long time, the dullness was treated almost as a virtue. The loan committee did not need to understand the global bond market. The board did not need to approve hotel towers in a city 3 states away. The manager did not need to court hot money from brokers. The institution lived close to its depositors and its borrowers. In smaller towns, the savings and loan could feel like part of the civic furniture, as ordinary as the post office, the church, the courthouse, or the diner, with the same men sitting in the same booth every morning. People trusted it partly because it had always been there. That is one of the most powerful and dangerous phrases in finance. It has always been there. People say it about banks, companies, employers, pensions, neighbourhoods, currencies, governments. They say it until the day it is not true anymore. Now, we should not romanticize this old thrift world too much. It had limitations. Some families were excluded from mortgage credit by discrimination, redlining, restrictive covenants, and local prejudice that could make the dream of home ownership much easier for some Americans than for others. A local institution could know the neighbourhood, but it could also enforce the neighbourhood's boundaries in unfair ways. The safe little bank on the corner was not equally safe or equally welcoming for everyone. The history of American home finance is also a history of who was allowed to buy, where they were allowed to buy, and whose savings helped build wealth, while others were kept outside the door. So when we speak of trust, we have to ask whose trust. When we speak of the American dream, we have to ask who was permitted to enter it. Still, within the world it served, the savings and loan carried an image of caution. It survived because people believed it was not gambling. It was connected to houses, and houses seemed solid. You could touch a house. You could walk through it. You could repair the porch. You could plant a tree in front of it. A mortgage was a long promise attached to something real. That sense of solidity shaped the public imagination around thrifts. The money was not disappearing into some abstract market. It was becoming a home. A family paid interest. Another family earned interest. The institution sat between them, quietly taking its margin. In the best version of the model, everyone understood the arrangement. The old business also created a particular kind of banker, not always noble, not always wise, but often cautious by training and habit. A thrift officer spent time thinking about appraisals, down payments, borrower income, neighbourhood values, and whether a mortgage could be repaid over many years. There was judgment involved, and judgment could be biased or flawed. But the basic loan was understandable. A borrower either made payments or did not. A house was worth something close to what comparable houses nearby were worth. The institution held the loan. It cared whether the borrower kept paying because the loan stayed on its own books. That point matters. When a lender holds the loan it makes, it lives with its own decision. If the loan goes bad, the loss comes home. That tends to discipline behaviour, at least more than a system where loans can be made, packaged, sold, and forgotten. Inside the old savings and loan, time moved differently. A 30-year mortgage forced an institution to think in decades. A passbook savings account might belong to a customer for half a lifetime. The institution grew through accumulated trust, not sudden expansion. Even the building seemed designed to communicate patience. Brick, stone, heavy counters, vault doors, conservative lettering, nothing too flashy. It wanted to say, without saying it, "We are not going anywhere." That message was valuable. People do not hand over their savings only because of interest. They hand them over because they believe the place will still exist when they return. But the seeds of the later crisis were already hidden in this safe design. The old thrift model depended on a stable world. It depended on depositors being willing to leave money in accounts that paid controlled rates. It depended on mortgage loans producing steady income. It depended on interest rates not moving violently enough to tear apart the spread between what thrifts earned and what they had to pay. It depended on regulations that kept the institution inside its narrow lane. And it depended on regulators who could supervise an industry that was simple enough to understand with the tools they had. The FDIC's historical review makes that point clearly. Before the 1980s, savings and loans had limited powers and relatively few failures, and the examination staff was adequate for the traditional S&L operation, but not designed for the more complex environment that came later. That is one of the quiet warnings in this story. A system can be well supervised for the world it was built for and dangerously underprepared for the world that replaces it. The old thrift supervisors understood traditional mortgage lenders. They understood small institutions with limited powers. They understood a slow business that did not change very much year to year. But when the rules changed, when institutions were allowed into new lines of business, when money moved faster, when the pressure to pay market interest rates collided with old low-yielding mortgages, the supervisory machinery looked smaller than the problem it faced. A tool built to trim a hedge is not ready to clear a forest. By the 1960s and 1970s, pressure was building. Interest rates rose. Inflation became more stubborn. Money market alternatives began to draw savers away from traditional accounts. Small savers, especially retirees living on interest, began to ask why they should be trapped in low-rate accounts while market rates moved higher elsewhere. The old controls that once seemed stabilizing began to look unfair and outdated. The Federal Reserve's history of Regulation Q describes how rising rates in the late 1960s and 1970s placed strains on the financial system, while money market mutual funds and other alternatives grew, in part because people wanted market returns rather than controlled deposit rates. Imagine being the manager of a small savings and loan in that moment. For years you have done what the system asked you to do. You took local deposits, you made home loans, you held long-term mortgages at rates that made sense when you wrote them. You followed the rules. You were cautious. You did not pretend to be Wall Street. Then the world changes. Inflation eats at everyone's patience. Market rates climb. Depositors come in and ask why they can get more somewhere else. Some of them leave. The money that once sat quietly in passbook accounts begins to move. You still have old mortgages paying old rates, but your cost of attracting money is rising. The safe little machine begins to shake. This is where the old virtue of playing it safe became, in a cruel way, part of the vulnerability. The thrift that had responsibly made fixed-rate mortgages in earlier years was now locked into those rates. It could not magically turn a 6% mortgage into a 14% mortgage just because the economy had changed. The borrower had a contract. The house payment was set. The thrift's income from that loan stayed the same while the cost of keeping deposits rose. What had once looked conservative now looked like a trap. The institution had done what it was built to do, and still it was in danger. There is something almost tragic in that. The crisis did not begin because every savings and loan forgot its purpose at once. It began because the old purpose collided with a new economic reality. Then, instead of accepting the painful limits of the old model and resolving weak institutions carefully, lawmakers and regulators opened doors. Some of those doors may have seemed reasonable at the time. Give thrifts more flexibility. Let them compete. Let them earn their way back. Let them make new kinds of loans. Let them grow. Let them survive. Each step could be defended in the language of rescue. But when a wounded institution is given new freedom without enough capital, strong supervision, or real discipline, freedom can become permission to chase losses. For the ordinary customer, none of this was visible yet. The lobby still looked the same. The pens were still chained to the counter. The teller still smiled. The passbook still received its stamped line. The institution still used words like savings, home, community, security. But beneath those words, the business model that had once made the thrift feel safe was beginning to fail. The little savings bank that had been built for passbooks and mortgages was about to be pushed into a world of deregulation High interest, brokered deposits, and speculative lending, it had never been designed to survive. And the men who understood how to exploit that new freedom were already moving toward the door. The little savings bank had been built for a slower kind of America, and that is the thing to remember before the doors open too wide. It had been built for the family with a passbook, the house with a mortgage, the quiet office where a loan officer looked at pay stubs and property values and asked whether the borrower could keep making payments through ordinary weather and bad weather alike. It had been built for a world where the rules were narrow enough that a cautious person could understand them. Money came in from savers. Money went out to home buyers. The difference between what the thrift paid and what the thrift earned kept the building open. That was not a glamorous machine, but it was a machine that made sense. Then the 1970s ended, and the machine began to make sounds that no one in the lobby could hear yet. Inflation was not a newspaper word anymore. It was in the grocery store, in the gas line, in the paycheck that seemed to shrink between Friday and Monday. Interest rates climbed higher and higher, and suddenly the old thrift business, which had once looked so safe because it moved slowly, began to suffer precisely because it could not move fast enough. Savings and loans held long-term fixed-rate mortgages, many written years earlier at lower rates, while depositors increasingly demanded returns that matched the new, high-rate world outside. The Federal Reserve's historical account explains that when interest rates rose, those old fixed-rate mortgages lost value, and the industry's net worth was essentially wiped out. Now, that phrase, net worth, sounds like something from an accounting office, and in a way it is. But inside a savings and loan, it meant something terribly simple. It meant whether the institution had enough real value left after you measured what it owned against what it owed. Imagine a family that bought a house years ago with a fixed income and fixed obligations, only to find the world around it suddenly twice as expensive. The stove still works, the curtains are still hanging, the neighbours still wave from the sidewalk. But the private arithmetic inside the house has changed. That was what happened to many thrifts. Their assets were not vanishing in a dramatic flash. The mortgages were still there. Families were still sending checks each month, but those checks were earning the thrift far less than the market now demanded. To keep savers from leaving, the thrift had to pay more. Every month the gap widened. Every ordinary day became a small financial wound. In 1980, federally insured savings and loans had positive net income of $781 million. In 1981, they lost $4.6 billion, and in 1982, they lost another $4.1 billion. Think about what that would have felt like from inside one of those buildings. The institution still opened on time. The employees still turned the key in the door. The teller drawer was counted. The phones rang. Customers came in with deposits and withdrawals and mortgage questions. Yet somewhere in the back office the numbers had gone sour. The old loans kept paying yesterday's interest while today's depositors wanted tomorrow's rates. And this is where a quiet kind of panic began. Not the panic of people running through streets, but the panic of balance sheets and board meetings. Men who had spent their careers making simple home loans now found themselves trapped between promises made in the past and prices set by the present. They had not necessarily done anything reckless yet. Many had simply done what the old system had told them to do. They had made fixed-rate mortgages. They had served local home buyers. They had played safe. Then the economy changed the meaning of safe. There is something humbling about that. We often tell financial crises as if they begin with villains rubbing their hands together in dark rooms, and sometimes there are villains. There were certainly men in the savings and loan crisis who deserved every bit of scrutiny and anger they received. But the first wound to the industry came from a larger collision. It came from the meeting of an old structure and a violent interest rate environment. The old thrift had borrowed short and lent long. Depositors could demand their money or chase higher returns. Mortgages could not suddenly transform themselves. The thrift was caught in the middle, like a person holding a door shut while the wind changes direction and starts pushing from the wrong side. And because savings and loans were tied so closely to home mortgages, Their weakness did not feel like the weakness of some distant financial machine. It was connected to the American house, the American yard, the American promise that if a family saved and borrowed carefully, life would move upward in a steady line. By the end of the 1970s, savers were no longer as patient as the old system required them to be. Why would they leave money in a low-paying account when other investments, money market funds and higher-yielding instruments were available? The old rules that limited what banks and thrifts could pay on deposits had once been defended as a way to prevent destructive competition. But in a high-inflation world, those ceilings looked unfair and unrealistic. A retiree who had done the responsible thing, saved carefully, avoided debt, and kept money in a local institution could see inflation eating the value of that savings. The controlled interest rate was not just a number. It was a slow leak in the future. The anger of savers mattered politically. The pressure on institutions mattered economically. And lawmakers, looking at an industry in pain and customers demanding better returns, began to loosen the old restraints. The Depository Institutions Deregulation and Monetary Control Act of 1980 was one of the first big moves. Even the name sounds heavy, like a crate in a government warehouse, but its effect was very real. It began the process of phasing out many interest rate ceilings on deposit accounts, expanded the ability of institutions to compete for funds, and raised federal deposit insurance coverage from $40,000 to $100,000 per account. That last part is important because it changed the size of the public promise behind the private institution. A saver could now place a much larger insured deposit into a bank or thrift, and the institution receiving that money could use it with a wider cushion of public confidence beneath it. The law was meant to modernize a financial system under pressure, but in the savings and loan world it also gave troubled institutions a dangerous new way to keep themselves alive. The FDIC's history notes that the 1980 law raised deposit insurance limits and reduced net worth requirements for insured savings and loans. Changes meant to help the industry, but which increased the eventual cost of the crisis. Here is the part that can feel a little backwards. When a healthy institution receives more freedom, it may use that freedom carefully. When a sick institution receives more freedom, it may use that freedom desperately. A thrift that was already losing money could now offer higher rates to attract deposits. The depositor did not necessarily need to understand whether the thrift was strong, because the deposit was insured. The thrift did not need to rely only on local savings gathered slowly from the town. It could attract larger sums, sometimes from far away, because the market was beginning to connect money to rates more than to relationships. That was a profound change. The old thrift had depended on trust built across counters and years. The new troubled thrift could buy deposits by paying more. If you were a careful manager, that might seem reckless. If you were an insolvent manager, it might seem like the only move left. There is a moment in many disasters when rescue and permission begin to look dangerously alike. The lawmakers and regulators did not wake up one morning and decide to create a scandal. They looked at an industry that was bleeding and tried to stop the bleeding. They thought flexibility might help. They thought competition might help. They thought the old restrictions were trapping thrifts in a world that no longer existed. And they were not entirely wrong about the pressure. The old world really was breaking. But loosening the rules around weak institutions is like handing car keys to someone who's already driven through the guardrail and telling him he may now choose any road he likes. The freedom may come too late to save him, and just early enough to let him harm others. The next great opening came with the Garn Saint-Germain Depository Institutions Act of 1982. President Ronald Reagan signed it in October of that year, and it was presented as a response to the pressure depository institutions faced as the Federal Reserve held interest rates high to fight inflation. It allowed savings and loans broader powers, including new kinds of lending that went far beyond the old home mortgage model. Thrifts could now move more aggressively into commercial real estate, development loans, and other investments that were supposed to help them diversify and earn their way out of trouble. Again, the theory had a surface logic. If If your old mortgage portfolio is losing value because interest rates changed, then maybe new, higher-yielding assets can restore health. Maybe the thrift can adapt. Maybe it can survive. But finance has a way of punishing the word maybe when it is spoken by people with insured money and little capital of their own at risk. The Garn-Sarton-Germain Act did not simply give strong thrifts new options. It also gave weak thrifts, some already in deep trouble, the power to place larger bets. The Federal Reserve's history says the Act allowed thrifts to invest in adjustable-rate mortgages and commercial real estate loans, and removed statutory limits on loan-to-value ratios, while the FDIC later concluded that these legislative actions increased the ultimate cost of the crisis. That sounds technical, but let us put it in the room. A savings and loan that had once mostly financed the house on Maple Street could now finance a shopping centre on the edge of a boomtown, an office building nobody had leased yet, raw land whose value depended on the next buyer being even more optimistic than the last, or a development proposed by men who understood enthusiasm better than repayment. There were people at the time who truly believed the answer to the thrift problem was growth. Grow out of the losses, grow into higher-yielding loans, grow into new markets, grow into the future faster than the past could pull you under. It is an intoxicating idea, especially when sitting still means admitting failure. If the old mortgages are dragging you down, make new loans. If local deposits are not enough, pay higher rates and bring in money from elsewhere. If the old business is too narrow, expand the business. There is always a language available for this kind of gamble. Innovation, flexibility, modernization, competitive equality. Deregulation often arrives wearing practical clothes. It says it is not here to make chaos. It is here to cut red tape, remove outdated barriers, help honest businesses breathe. And sometimes that is true. But when the red tape is wrapped around federally insured savings, cutting it without replacing it with stronger supervision can leave the public exposed. Now, I want to pause on supervision, because this is one of those plain words that carries enormous weight. Supervision is not glamorous. No one makes movies about examiners calmly reviewing loan files in fluorescent-lit offices. But supervision is one of the quiet ways a financial system protects people who will never read a balance sheet. It is the person asking whether the appraisal is real. It is the examiner wondering why a thrift with weak capital is growing so quickly. It is the regulator asking whether the same insider appears on both sides of too many deals. It is the boring question that prevents the exciting disaster. The trouble was that the supervisory system had been built for the old thrift industry, the local mortgage lender with narrow powers. It was not built for thousands of institutions suddenly allowed into broader, riskier territory. The FDIC's history says the examination staff was suited to the simpler, pre-1980s thrift business, but was not adequate for the complex new environment, and that many examiners lacked the training and resources needed to evaluate the new risks. There is something almost tragicomic about that mismatch. The doors were opened wider, but the people asked to watch the doors were not given enough eyes, enough hands, or sometimes enough authority. Thrifts were moving into commercial real estate and higher risk assets, while regulators were trying to understand businesses these institutions had not historically conducted. The old examiner who knew how to review residential mortgages now had to look at speculative development loans, land deals, complex ownership arrangements, brokered deposits, and aggressive growth strategies. The rulebook had changed, but the guardrails had not been rebuilt quickly enough, and in that gap the crisis found room to grow. Then there was the problem of capital. In ordinary life, capital is a cushion. It is the owner's stake. It is the money that takes losses before deposit insurance or taxpayers have to step in. A well-capitalized institution has something to lose, and that tends to make its managers more cautious. A thinly capitalized or insolvent institution lives differently. It can begin to act like a gambler already deep in debt. If the next bet works, perhaps it survives. If the next bet fails, the loss belongs partly to someone else. During the early 1980s, regulators often practiced forbearance, allowing troubled thrifts to remain open in the hope that time, Falling interest rates and new earnings would repair them. The Federal Reserve's history describes how many insolvent or nearly insolvent thrifts continued operating, attracting deposits by paying high rates and pursuing risky strategies sometimes called go for broke. That phrase deserves to be heard slowly. Go for broke. It sounds like a slogan from a card table or a racetrack. It does not sound like something that belongs beside the savings of schoolteachers, machinists, widows, retirees, and families putting money aside for a home. But that is what the structure encouraged in some places. The thrift did not have to convince every depositor that its managers were wise. It could offer a high rate. Deposit insurance made the promise feel safe. Money flowed in, the institution grew, and growth from the outside can look like health. A building with more deposits, more assets, more loans, and more branches can appear successful to people who cannot see the quality of what sits behind the numbers. But a tumour also grows. Growth tells you something is expanding. It does not tell you whether it should be. The old local relationship between depositor and thrift began to weaken as brokered deposits became more important. A broker could gather funds from investors seeking high insured returns and place them in institutions willing to pay. The depositor might live nowhere near the thrift. They might never see its lobby, never meet its manager, never know whether the money was being used to finance ordinary mortgages or speculative ventures. The thrift, meanwhile, could gather large sums rapidly without building a local base of trust. That changed the speed of the business. A neighbourhood thrift had once grown at the pace of local savings. A deregulated, high-rate thrift could grow at the pace of ambition. The Federal Reserve notes that between 1982 and 1985, thrift industry assets grew by 56%, more than twice the rate of commercial banks, as deposits flowed into institutions willing to pay high rates. Imagine standing on the sidewalk outside one of these institutions in 1984. Nothing about the building tells you that its balance sheet has become dangerous. The sign may still use the same comforting words: federal, savings, home, security. The lobby may still look dull in the reassuring way bank lobbies often do. A customer may still walk out holding a receipt, perfectly calm. But the institution may now be funding deals that would have been unthinkable under the old model. It may be chasing commercial real estate. It may be dependent on expensive deposits that can disappear as soon as another institution offers a better rate. It may be relying on optimistic appraisals, insider relationships, or the hope that land values will keep climbing. The danger is not visible because finance hides its rot inside documents. A cracked bridge shows you its crack. A bad loan can sit in a file cabinet looking perfectly proper until the borrower stops paying and the collateral turns out to be worth far less than promised. This is one of the reasons financial history can be so unsettling. The tools of disaster are often ordinary: a loan agreement, an appraisal, a deposit certificate, a board resolution, a regulation amended in careful language. No one has to kick down a door. No one has to threaten a teller. Money can be put at risk with signatures, stamps, and the calm vocabulary of business. The savings and loan crisis was full of that calm vocabulary: diversification, asset growth, market rates, capital forbearance, net worth certificates, regulatory relief. Each phrase sounds reasonable by itself. Together, under the wrong incentives, they helped create a world where weak institutions could become larger and more dangerous before they finally failed. And the incentives were the heart of it. Suppose you controlled a thrift that was already insolvent in economic reality, though not yet closed. If you made safe loans, you might earn a little, but not enough to restore the institution. If you made risky loans and they succeeded, you might save the thrift and perhaps make yourself wealthy. If they failed, federal insurance would protect insured depositors, and the loss would be absorbed by the insurance fund, then perhaps by the public. The upside was private. The downside was shared. That is not simply bad luck. That is a structure that invites bad behaviour from people inclined to it, and tempts desperate behaviour from people who might once have been cautious. Not everyone gave in. It is important to say that plainly. many savings and loans remained conservatively managed. Many officers were horrified by what they saw competitors doing. Imagine being the manager of a careful institution in a town where a reckless thrift down the road is offering higher rates because it no longer fears tomorrow. Your customers ask why you cannot match the rate. You know why, but explaining prudence is difficult when someone else is buying deposits with danger. You can say, "We are safer," but the other institution can say, "We pay more and your money is insured." In that kind of competition, honesty can feel like a disadvantage. The reckless institution does not merely endanger itself. It pressures the cautious institutions around it, distorts the market, and teaches customers to judge safety by yield. There is a small human detail hidden in this that I find worth lingering over. For an ordinary saver, a higher interest rate did not feel like greed. It often felt like survival. Retirees living on fixed incomes had watched inflation erode their savings. Families trying to build down payments wanted their money to grow. People had every reason to ask for better returns. They had not created the moral hazard. They had not designed the deregulation. They had not undercapitalized the FSLIC. They simply responded to the world in front of them. If a federally insured institution offered a better rate, why not take it? That is what makes the crisis so morally complicated. The reckless system did not require every participant to be reckless. It only required ordinary people to follow ordinary incentives while insiders and weak institutions took advantage of the structure around them. The politicians, too, were operating in a world of pressure. Inflation had made the old rules unpopular. The thrift industry was pleading for relief. Home building and mortgage credit mattered deeply to the economy. Nobody wanted to be blamed for letting thousands of institutions fail if there was a chance they could recover. The early 1980s were full of faith in deregulation across many parts of American economic life. Rules that had been built after the Great Depression were increasingly described as outdated, heavy, and unable to handle modern markets. To many people, loosening the thrift industry looked not reckless but necessary. It looked like giving a trapped industry the tools to free itself. But a trapped industry is not always freed by handing it sharper tools. Sometimes it cuts through the floor. The law gave savings and loans ways to seek higher earnings, but it did not create enough discipline to make sure they used those powers safely. It allowed them into broader lending but did not ensure that their managers understood the risks. It tolerated capital weakness in the hope that time would heal it. It raised deposit insurance coverage, increasing the amount of protected money that could flow into aggressive institutions. It relaxed the old deposit rate world, allowing money to move more quickly toward the highest bidder. And all of this happened while the insurance fund responsible for protecting thrift depositors was not prepared for the scale of losses that would come. The FSLIC, the Federal Savings and Loan Insurance Corporation, was supposed to stand behind the industry. But an insurer is only as strong as its resources and the losses it must cover. If a few institutions fail, the fund can manage. If hundreds of institutions become deeply troubled, the fund itself becomes part of the crisis. By allowing weak thrifts to continue operating, regulators sometimes delayed recognition of losses that were already there. Delay can look merciful at first. It avoids immediate closures. It avoids headlines. It gives everyone a chance to hope. But in finance, delay can also give bad assets time to multiply. A small fire in the wall is easier to put out than a whole burning house. If you keep telling yourself the smell of smoke is probably nothing, the eventual damage may be far worse. There were warnings. Not everyone was blind. Some examiners, economists, journalists and officials saw the danger of mixing deregulation, weak capital, deposit insurance, and inadequate supervision. But warnings are difficult to hear when they arrive before the disaster becomes undeniable. They can sound pessimistic. They can sound anti-business. They can sound like obstacles to recovery. And when an industry is politically connected, locally important, and wrapped in the language of homeownership, closing institutions is not easy. Every failed thrift has customers. Every closure has political consequences. Every regulator who moves aggressively can be accused of destroying local businesses or cutting off credit. So the system drifted, not always because no one understood the problem, but because the solution required admitting losses people were desperate not to admit. This is where the doors opening too wide becomes more than a metaphor. The first door opened to higher deposit competition. The second opened to larger insured deposits. The third opened to new lending powers. The fourth opened to regulatory patience. The fifth opened to brokered money. Behind each door was a plausible argument. Behind all of them together was a room filling with risk. And once the wrong people saw that room, they understood its possibilities very quickly. A federally insured thrift with weak supervision could become a beautiful machine for someone willing to use it badly. It could gather money because the government guarantee comforted depositors. It could make loans to projects whose true risk was hidden behind hopeful appraisals. It could reward insiders before losses were recognised. It could keep growing long after a sober accounting would have stopped it. Let us not imagine this as one national switch flipped from safe to corrupt. It was messier than that. Some states had looser rules than others. Some regions had real estate booms that made risky lending look brilliant for a while. Some thrift executives were merely inexperienced. Others were reckless. A smaller number were criminal. Some regulators tried hard with too few resources. Others were too slow or too close to the industry. The crisis developed unevenly, one institution at a time, one loan file at a time, one optimistic assumption at a time. But the national pattern became clear enough. Deregulation did not cause high interest rates, and high interest rates did not by themselves require fraud. But together, with deposit insurance and weak supervision, they created the conditions in which gambling with other people's savings could appear not only possible, but profitable. And through all of it, the ordinary customer kept walking through the door. That is the image I keep returning to. The customer did not see deregulation. The customer did not see net worth certificates. The customer did not see a thrift's interest rate gap or the risk profile of its commercial real estate portfolio. The customer saw a building that had always looked safe. They saw the word insured. They saw a higher rate. They saw a teller who might have been working there for 15 years. They saw the same clock on the wall, the same counter, the same little deposit slips. History often turns on the distance between what ordinary people can see and what is actually happening beneath the surface. By the middle of the 1980s, that distance had become dangerous. The old savings and loan had been transformed in law and practice, but not always in public imagination. People still thought of thrifts as home lenders. Some still were. But others had become something very different. Thinly capitalised, fast-growing, high-rate institutions searching for returns large enough to outrun their own wounds. When the real estate market stayed hot, the danger could be disguised as success. New developments appeared, loans were booked, interest was promised, asset growth was celebrated. The men making the deals could talk about the future with extraordinary confidence. But confidence is not collateral. Optimism is not cash flow. And when a loan depends on prices rising forever, the first pause in the market can feel like a trap door opening. The doors had opened too wide, and now money was moving through them faster than caution could follow. The next part of the story belongs to the developers, the deal makers, the appraisers, the insiders, and the empty places they left behind. Because once the old rules no longer held the thrift close to the home mortgage, the money began looking for bigger promises, and bigger promises often came attached to land, concrete, glass towers, shopping centres, and projects that looked magnificent on paper, right up until the day someone asked whether they could actually pay for themselves. The money began looking for bigger rooms to occupy. That is one of the strangest things about money, when the rules around it change. It does not stay politely where people remember it belonging. It does not remain in the passbook, the mortgage office, the neat little world of local deposits and modest home loans just because the sign outside the building still says savings. Once money can move faster, once it is protected by insurance, once weak institutions are allowed to pay high rates to attract it, and once the people controlling those institutions are told they may go beyond the old limits, the money starts listening for promises. Bigger promises, faster promises, promises wrapped in drawings of office towers, desert subdivisions, shopping centres, hotels, condominiums, and new communities with names that sound like they were invented before anyone checked whether people actually wanted to live there. The old savings and loan had once helped a family buy a house. The new risky thrift could help a developer imagine an entire horizon, and if that horizon never became real, the loan file could sit for a while pretending otherwise. This is where the savings and loan crisis moves out of the quiet branch lobby and into the land itself. You can almost see the change if you slow the scene down. First, there is a map spread across a conference table. Then there is an appraisal, typed and signed, saying the land is worth more than it was worth last year and will surely be worth more next year. Then there is a developer with a proposal, a banker with a problem, and an institution that needs high-yielding assets because its old mortgage portfolio is not enough to save it. Then there is a loan, then another loan, then a project sign beside a road, promising luxury living, executive suites, retail space, opportunity. For a while, before the market turns, all of it can look like progress. Bulldozers look like confidence. Concrete looks like proof. A half-built building can seem more real than the doubts that should have stopped it. But one of the dangerous lessons of this crisis is that something can be financed long before it is needed. A shopping centre can be funded before customers exist. An office tower can rise before tenants are signed. A subdivision can be graded before families arrive. And because land values in a boom can appear to justify almost anything, a project can seem profitable on paper, even while it is quietly becoming impossible in the world. In the early 1980s, deregulation had allowed many thrifts to move into commercial real estate and development lending, businesses far beyond the plain residential mortgages they had been built to handle. The Federal Reserve's history of the crisis notes that thrifts expanded into commercial real estate, construction, and other riskier loans after deregulation, and that between 1982 and 1985 thrift industry assets grew by 56%, more than twice the growth rate of commercial banks. That growth was not evenly spread across the country. It gathered in places where optimism already had a running start: Texas, Arizona, California, Colorado, Florida. Parts of the Southwest and Sun Belt where population growth, oil money, land development, tax incentives and easy credit made the future feel almost visible from the highway. In those places, the 1980s did not begin with ruins. They began with movement. Roads were being extended, suburbs were pushing outward, office parks were appearing where fields had been. Builders talked about migration, energy wealth, business relocation, sun, space, and the next great American boom. A banker who wanted to believe had plenty of reasons to believe. A regulator who wanted to wait could tell himself that the collateral might recover. A developer who needed another loan could point to yesterday's sale as evidence that tomorrow's price would be higher still. Texas is especially important here, because it became one of the great landscapes of the savings and loan disaster. The state had experienced a powerful boom tied to oil, construction, and real estate, and then a painful reversal when oil prices fell and commercial real estate weakened. FDIC history on banking problems in the Southwest describes how Texas real estate values climbed, with oil prices in the early 1980s and then declined after oil prices dropped, while troubled banks continued increasing concentrations in construction and land development loans, even after local real estate markets had begun to weaken. Although the FDIC section discusses banking problems in the Southwest more broadly, the same regional forces fed the thrift crisis too. Real estate that had looked endlessly valuable became collateral, whose value depended on memories of a boom that was already ending. Now, let us walk into one of those deal rooms, not because every deal looked exactly the same, but because the pattern matters. A developer comes in with land. Maybe he owns it. Maybe he has an option to buy it. Maybe he has already borrowed against it elsewhere. The land is not producing income. It is not yet an apartment complex or a shopping centre or an office park. It is simply land, which means its value depends heavily on what people believe can be done with it. If everyone believes the area is growing, the appraisal can climb. If the appraisal climbs, the thrift can justify a larger loan. If the larger loan is made, the developer can begin work, pay fees, pay interest for a while, perhaps even take money out through related companies, management agreements, or inflated costs. The project now has movement around it. Movement can be mistaken for success. The appraisal was one of the quiet weapons in this world. It did not look dangerous. It looked professional. It had pages, numbers, comparable sales, assumptions, signatures. But an appraisal is not a law of nature. It is an opinion dressed in formal clothing. In a rising market, appraisals can become optimistic without seeming absurd. In a corrupt or reckless environment, they can become fantasy with letterhead. A piece of land that was bought for one number could be appraised for a much higher number if the future was described brightly enough. A thrift desperate for high-yield loans could accept assumptions that a healthier institution might have questioned. A developer could borrow against values that depended on other people continuing to believe. And because the loan itself created activity, the activity seemed to confirm the belief. This is what people mean when they say the money was not really there. The deposits were there, at least at first. The checks cleared, the funds could be wired, workers could be paid, dirt could be moved. But the value supposedly supporting the deals was often far more fragile than the documents admitted. The profit was not there yet. The tenants were not there yet. The buyers were not there yet. Sometimes the real equity was not there either. What existed was a chain of confidence connecting insured deposits to speculative collateral through a loan file. If any strong link had held, perhaps the deal could survive. But too often the links were weak all the way down. Weak thrift, weak capital, weak supervision, weak appraisal, weak borrower equity, weak market demand. It looked like finance. It was, in many cases, a bet that tomorrow would rescue today. There is something almost theatrical about real estate speculation during a boom. It has props. It has costumes. It has models of buildings under glass. It has brochures printed on expensive paper. It has architects' drawings with perfect trees and clean sidewalks, and little painted people walking across plazas as if they have already decided to spend their lunch hour there. The project always appears in sunshine. The parking lot is always full enough to imply success, but never so crowded that it feels inconvenient. The office windows shine. The condominium balconies face a future that has not yet been tested. And when money is easy, these drawings can become collateral for more money. A drawing becomes a loan. A loan becomes a clearing site. A clearing site becomes a partially built structure. A partially built structure becomes evidence that the project is serious. Then more money is needed because now stopping would make the loss visible. That last part matters. Once a bad project has begun, everyone has an incentive to keep it looking alive. The developer wants more financing because failure means exposure. The thrift may want to extend or renew the loan because foreclosure would force it to recognize the loss. The regulator may hesitate because closing the thrift would cost money the insurance fund does not have. So the same story keeps being told. Give it more time. Let the market recover. Complete the project and it will sell. Refinance it and it will stabilize. Lease it and it will cash flow. The future is asked to solve the present. The present keeps borrowing. The FDIC's history of the savings and loan crisis is blunt about the danger of this environment. It explains that deregulation gave thrifts new powers, while supervisory resources were not adequate for the more complex risks these institutions began taking. And it notes that weak or insolvent thrifts were sometimes permitted to continue operating under forbearance rather than being closed promptly. That combination allowed losses to grow inside institutions that should have been stopped earlier. The problem was not simply that a few loans went bad. Loans always go bad in banking. The deeper problem was that institutions with little real capital were allowed to increase risk at the very moment when discipline should have been strongest. Now, imagine being a developer who understood this. Not every developer was a criminal. Many were simply swept up in the optimism of the period and borrowed in good faith, expecting the market to continue. But some men looked at the savings and loan world and saw something extraordinary. They saw federally insured money being gathered by institutions hungry for high returns. They saw regulators stretched thin. They saw thrift managers willing to enter deals they might not fully understand. Some even saw the opportunity to control the source of lending itself. If you could own or influence a thrift, you did not merely ask for money. You could direct it. You could finance your own projects. You could make loans to related parties. You could turn a deposit institution into a private engine. This is where the old line between banker and borrower began to blur. A thrift was supposed to evaluate borrowers, not become a captive purse for them. But in some of the worst cases, insiders used their institutions to fund ventures that benefited themselves, their associates, or related businesses. The Office of Thrift Supervision later described the failure of Lincoln Savings and Loan as resulting in large measure from insider abuses in an enforcement decision involving Charles Keating, and estimated that Lincoln's failure would cost taxpayers $2.6 billion. Lincoln became one of the most famous symbols of the crisis, not because it was the only bad thrift, but because it seemed to gather so many elements of the disaster into one story: deregulation, aggressive growth, real estate ventures, political influence, regulatory conflict, and ordinary people left stunned by losses they had never imagined when they walked into what looked like a safe institution. Lincoln's story had its own particular shape. Charles Keating's American Continental Corporation bought Lincoln Savings in 1984, and Lincoln then expanded aggressively. The Guardian, summarizing the case after Keating's death, reported that American Continental's purchase of Lincoln was followed by growth from $1.1 billion to $5.5 billion over 4 years, and that customers were sold roughly $200 million in unsecured bonds that became worthless when American Continental went bankrupt. That bond-selling part is not the whole savings and loan crisis, but it shows something essential about the atmosphere around it. The name of a thrift could carry an aura of safety even when the product being sold was not federally insured in the way depositors assumed. People trusted the building, they trusted the relationship, they trusted the familiar surface, and sometimes that trust was used against them. There is a particular cruelty and financial harm that arrives wearing familiar clothing. A person may understand that the stock market is risky. They may understand that a casino is built to take more than it gives. But a savings institution is different. It borrows the emotional authority of thrift itself. It says, or seems to say, you are not gambling by coming here. You're being prudent. You're doing what responsible people do. That is why it mattered so much when the risk moved under that roof. The danger did not announce itself as danger. It came in through higher interest, polished brochures, professional language, and the comforting fact of insurance that covered some things but not others. In the development world, money could also be made before a project succeeded, and that is another uncomfortable truth. Fees can be collected at closing, salaries can be paid, related contractors can receive work, land can be flipped, interest can be capitalized, meaning unpaid interest is added to the loan balance, making the paper asset look larger even when cash is not coming in. A loan can be extended. Another loan can be made to cover the first. A borrower can appear current because new borrowed money is used to pay old interest. The surface remains smooth. The file remains active. The loss remains hidden. But beneath that surface, the institution is no longer earning money from a real productive project. It is feeding a paper machine. That paper machine was especially dangerous because accounting can sometimes delay truth. A bad loan does not always become a recognised loss the day it becomes bad in reality. If the borrower is extended, if the collateral is reappraised optimistically, if interest is capitalised, if the market is expected to recover, the institution may postpone admitting what has happened. For a weak thrift, postponement can feel like survival. For an insider, postponement can create time to extract more value. For the insurance fund, postponement can turn a manageable loss into a larger public bill. This is why delayed recognition is one of the recurring villains in financial history. It allows everyone to keep speaking in the future tense while the past is already lost. Picture an unfinished office building on the edge of a Texas city in the mid-1980s. The frame is up. The windows may be partly installed. Wind moves through floors where desks were supposed to be. The parking lot is still dirt. A sign announces leasing opportunities with a phone number that rings in an office where people are trying to sound confident. In the loan file, the project has a value. On the ground, the value is less certain. It depends on tenants who may not come, businesses that may not expand, oil prices that may not recover, buyers who may already be gone. The building stands there like an argument between paper and reality. The paper says asset. Reality says empty. Some of these projects were not merely unlucky, they were absurd. The Federal Reserve's history gives one of the most vivid examples from Texas. In 1987, federal thrift insurers determined that some unfinished condominium units, financed by a bankrupt savings and loan, were worth less than nothing, and it was cheaper to burn them than to sell them. That image is so stark that it almost feels symbolic beyond belief. Buildings made possible by insured deposits, speculative optimism, and regulatory delay being deliberately destroyed because their existence had become a cost. The money that built them was real when it left the thrift. The value they supposedly represented was not. There is an old human weakness underneath all of this, and it is not limited to bankers or developers. We like rising numbers. We like believing that what we own is worth more than it was. We like a story where land becomes wealth simply because time passes and more people arrive. Real estate has a special power over the imagination because it looks solid. You can stand on land. You can touch a wall. A building does not flicker like a stock quote. It appears to exist outside panic. But land values can be just as emotional as any market. A field can be worth one number when people believe a freeway is coming, another number when the freeway goes elsewhere, and another number entirely when the lender finally has to sell it after the borrower fails. The dirt did not change. The story around the dirt changed. During the boom, the story was often generous. Appraisals assumed growth. Developers assumed buyers. Thrifts assumed yields. Regulators assumed time. Politicians assumed rescue without reckoning. And because each assumption helped support the next, the whole structure could stand for longer than common sense might suggest. That is the thing about bubbles and speculative credit. They do not feel irrational while you're inside them. They feel like participation in a shared future. The man who doubts too early looks timid. The lender who refuses too many deals loses market share. The regulator who acts too aggressively is accused of strangling recovery. The developer who borrows boldly looks visionary until the day he looks reckless. There were also tax incentives and broader real estate forces pushing the story along. The early 1980s tax environment encouraged real estate investment in ways that contributed to overbuilding, and then the 1986 Tax Reform Act reduced some of those advantages, hurting values in already overbuilt markets. The Library of Economics and Liberty's overview of the S&L crisis describes this as a double whammy, with the 1981 tax law encouraging too much commercial real estate construction, and the 1986 changes damaging the value of what had already been built. That does not explain everything, but it helps explain why so much money poured into buildings and land at exactly the wrong time. The financial system was not simply responding to organic demand. It was being pulled by rules, incentives, and expectations that made construction look more attractive than it really was. Let us return to the people inside the thrift, because not everyone there was sitting at the top of the deal. A loan officer may have seen questionable files. An examiner may have been told to move carefully. A mid-level employee may have watched insiders receive treatment ordinary borrowers would never get. A teller may have continued greeting depositors while rumours moved through the staff. The inside of a failing institution often has a strange atmosphere. Everyone knows something is wrong before anyone is allowed to say it plainly. Conversations become shorter when certain people enter the room. Doors close, files are requested, auditors appear, senior managers project confidence too loudly. Employees go home and tell their spouses they are not sure what is happening, only that it does not feel right, and still the deposits come in. That is perhaps the most unsettling part. The thrift can be making terrible loans while the lobby remains ordinary. A grandmother can deposit a certificate of deposit in the morning, while, that same day, someone upstairs approves financing for a project that will never repay. The saver sees insurance and a promised rate. The executive sees funding. The developer sees opportunity. The public promise of safety becomes the fuel for private ambition. That is why deposit insurance must be paired with strong supervision. Insurance without discipline calms the depositor but can embolden the institution. It prevents a bank run, which is good, but it can also hide market warning signs, which is dangerous. The depositor no longer needs to ask hard questions, so the regulator must ask them. If the regulator cannot or will not, the silence becomes expensive. The deals kept expanding because for a while, failure could be deferred. A development that could not pay might be refinanced. A borrower who could not repay might receive more credit. A thrift that was already weak might grow larger. The Federal Reserve describes this as the go-for-broke strategy, pursued by some insolvent or nearly insolvent thrifts. They attracted deposits by paying high rates and then invested in increasingly risky projects, hoping large returns would restore them. It is hard to imagine a phrase more opposed to the old thrift spirit. Go for broke does not belong beside a passbook. It does not belong beside a family's down payment. It does not belong beside federal insurance. But by the 1980s, in too many places, that was the real strategy beneath the respectable surface. Some developers became local celebrities during the good years. They sponsored events. They gave interviews. They appeared at openings with oversized scissors and hard hats that looked too clean. They spoke the language of jobs, growth, and confidence. Communities often want to believe in builders because builders seem to create the future with visible hands. A developer can point to land and say, here will be homes, here will be stores, here will be offices, here will be tax revenue, here will be life. It is difficult for a town to resist that story, especially in places hungry for growth. A cautious banker asking whether the cash flow works can sound like a pessimist. An examiner questioning the appraisal can sound like a bureaucrat. The person urging restraint rarely gets invited to the ribbon cutting. But when the market turned, the same projects that had promised prosperity became evidence. Empty buildings do not keep secrets. Vacant lots do not explain themselves. A half-finished condominium complex says something went wrong even before you read the loan documents. And the Resolution Trust Corporation, created later to clean up the failed thrifts, would inherit not only financial claims but physical reminders of the boom. Land, loans, office buildings, apartment complexes, unfinished developments, and properties scattered across markets where too many lenders had believed too many versions of the same future. The cleanup became one of the largest asset disposition tasks the government had ever faced, because the crisis had converted insured savings into hard-to-sell real estate and troubled loans. The Federal Reserve notes that the Resolution Trust Corporation eventually resolved 747 failed thrifts with assets of more than $407 billion. There is a quiet moral question inside this part of the story. Who was really gambling? The saver did not think he was gambling. The teller was not gambling. The family that trusted the institution was not gambling. But the thrift, the developer, the insider, the broker, The appraiser, the politician who looked away, the regulator who waited too long, each stood somewhere near the table. Some placed bets directly. Some enabled the game. Some pretended it was not a game at all. And the reason the public anger became so deep was that the chips on the table were not only private fortunes, they were insured deposits, public guarantees, and eventually taxpayer money. The game was played in private rooms, but the losses walked out into the country. When we speak about the money that was not really there, we're speaking about more than fraudulent loans or failed projects. We're speaking about the strange ability of a financial system to create a picture of wealth before wealth exists. A land appraisal can create borrowing power. Borrowing can create construction. Construction can create the appearance of progress. Progress can justify more lending. More lending can temporarily hide the weakness of the first loan. Each step adds paper. Each paper says value. But if the final project cannot support itself, if buyers do not arrive, if tenants do not sign, if the collateral cannot be sold for the value claimed, then the earlier wealth was partly imaginary. It was a shadow cast forward from a future that never came. By the time the truth began breaking through, it did not break through gently. It arrived in failed institutions, seized assets, criminal investigations, congressional hearings, devastated bondholders, and long lists of properties that had to be sold for whatever the market would pay. It arrived in the faces of employees leaving thrift offices with boxes. It arrived in communities where a gleaming development became a reminder not of growth, but of gullibility. It arrived in the bitter discovery that a bank could appear prosperous because it was growing, while the growth itself was making the final collapse worse. And now, after the developers have made their presentations, after the loans have been signed, after the appraisals have done their quiet work, after the land has been cleared and the money has moved, we need to step inside the failed thrifts themselves. Not the idea of them, not the legislation around them, but the buildings and offices where the crisis finally became visible. Because there comes a moment when paper can no longer hold back reality, when the loan files cannot be rearranged into health, when the deposits that once flowed in are not enough, when the examiners arrive, and when the place that once promised safety has to admit that behind the polished counter there may be almost nothing solid left. The first thing to understand about a failed savings and loan is that failure did not always look like failure from the sidewalk. That is one of the unsettling truths of this entire story. A thrift could be dead in its books and still alive in its lobby. The lights came on in the morning, the doors opened, the same teller stood behind the counter, the same framed advertisement promised a better rate on certificates of deposit. The same little plastic tray held deposit slips and withdrawal forms. A customer walking in at 10:15 on a Tuesday might see nothing dramatic at all. No shouting, no broken glass, no desperate men carrying boxes into trucks. Just a bank office, clean and quiet, performing the motions of ordinary life. But in the back room, inside metal file cabinets and aging computer systems and thick loan folders with tabs curling at the edges, the truth had already started to rot. A failed thrift was often not one bad decision. It was a building full of bad decisions that had been allowed to keep breathing. One bad loan could be explained. A borrower got unlucky. A neighbourhood declined. A construction project stalled. Weather interfered. Oil prices fell. Tenants did not come. That happens in lending. But when you opened the files of some of the worst thrifts, you did not find one unlucky loan. You found a pattern. You found land loans made on values that no longer existed. You found commercial real estate projects that had never produced enough income to carry their debt. You found borrowers connected to insiders. You found appraisals that depended on assumptions too generous to survive contact with a real buyer. You found loans extended, renewed, restructured, and carried forward because admitting the loss would have made the institution's weakness impossible to hide. The folder said asset. The market said trouble. The thrift kept choosing the folder. By the time regulators stepped inside many of these places, the difference between the official story and the real one could be enormous. On paper, a loan might still be listed at close to full value. On the ground, the collateral might be an empty lot, a half-built condominium, a vacant office building, or land that could only be sold at a fraction of the amount used to justify the original loan. This was the strange physical geography of the savings and loan crisis. The loss was not just a line in an accounting statement. It was a quiet branch office with too few customers. It was a development sign fading in the sun. It was a row of unfinished units with weeds growing where landscaping had been promised. It was a project whose brochures were more complete than the building itself. Inside the thrift, employees often sensed the danger before the public did. That is true in many failing institutions. People who handle the paper can feel when the paper has changed. A loan clerk notices the same borrower receiving extensions again and again. A secretary sees executives taking more closed-door meetings with developers and lawyers. A teller hears customers ask why the newspapers are mentioning the institution's name. A bookkeeper watches numbers become harder to explain. Nobody may say the word failure out loud, but the office begins to behave differently. Voices lower, certain files are requested and then not returned quickly. Senior managers speak with forced confidence. Examiners arrive and are treated with a mixture of politeness and dread. The staff keeps working because paychecks still come, and because in a bank, ordinary routine is itself part of the performance of trust. The trust was the most fragile thing in the building. The vault door looked heavy, and the counters looked polished, and the sign outside looked official, but the real foundation of a financial institution is not brick. It is belief. People believe the institution is sound enough to hold their money. People believe the regulators are watching. People believe insurance means safety. People believe the friendly person behind the desk would not work in a place that is falling apart. Once that belief begins to crack, the entire room changes even if the furniture is not moved. A customer no longer sees a teller, he sees a question. A receipt no longer feels like proof. It feels like a promise whose fine print suddenly matters. One of the reasons the public did not always panic immediately was federal deposit insurance. That was the point of insurance. It had been created to stop fear from destroying banks and thrifts that might otherwise survive. In the Depression, people had learned what a line outside a financial institution could do. If everyone wants their money at once, even a healthy lender can be forced into disaster because its money is tied up in loans. Deposit insurance told ordinary savers that they did not need to run. But in the savings and loan crisis, that same reassurance also meant that many troubled thrifts could keep attracting money longer than they should have. Customers looked at the insured rate, not the loan portfolio. They did not inspect the thrift's capital. They did not know whether the institution was making conservative mortgages or speculative development loans. Why would they? That was supposed to be someone else's job. For years, too many weak institutions were allowed to remain open in the hope that time would solve what discipline had not. By 1986, a later congressional research summary noted 441 thrifts with $113 billion in assets were already insolvent. That number is not simply large. It is a sign that failure had become systemic before the public fully grasped it. 441 institutions were not a few careless offices scattered around the country. They were evidence that the industry's trouble had moved beyond bad luck and into the structure of the system itself. The old thrift world had been built for caution. The new thrift crisis had produced a population of institutions that could not truly pay for the promises still being made under their names. Now imagine being an examiner walking into one of these places. You do not arrive with a movie scene around you. You arrive with files, authority, and not enough time. You ask for loan documents. You ask for appraisals. You ask for records of insider transactions. You ask about extensions, renewals, delinquencies, and collateral. You sit under fluorescent lights and read the evidence of optimism after optimism after optimism. You may find that a loan was made on a project that never had enough borrower equity. You may find that interest was not being paid from real income but added to the loan balance. You may find that the same small circle of developers and insiders kept appearing. You may find that the institution's reported health depended on values that no buyer would pay. And then you have to translate all of that into conclusions people will resist because conclusions have consequences. A regulator who says a thrift is insolvent is not merely writing a word. He is pushing toward closure, receivership, loss recognition, and public cost. He is forcing people to admit that the institution is not what it claimed to be. Managers may argue, lawyers may object, politicians may receive calls, customers may be frightened, employees may lose jobs, communities may feel punished. The easy thing, in the short term, is often to wait. Give the loans more time, give the real estate market more time, give management a chance, give the institution room to recover, but each extra month can let losses deepen. The unpaid interest grows, the bad collateral decays, the insiders have more time. The final bill becomes harder to pay. This was one of the bitter lessons of the crisis. A failed thrift left open was not harmless. It could keep gathering insured deposits and making new loans. It could keep paying high rates to attract money. It could keep pretending growth was recovery. The Federal Reserve's history describes how zombie thrifts paid high rates to bring in deposits and then pursued risky projects in a go-for-broke attempt to earn their way back to health. A zombie thrift is a disturbing phrase, but it works because the institution still moves after its economic life is gone. It has a sign, a staff, a balance sheet, and deposit accounts. It can still do damage. The danger is not that it collapses immediately. The danger is that it keeps walking. Inside these places, the files could tell stories the advertisements never did. A loan for a shopping centre that opened half empty. A loan for land whose value depended on a road extension that never came. A loan to a borrower who had already borrowed heavily from other institutions. A loan approved because everyone assumed the market would rise. A loan kept current by another loan. The language was clean, non-performing asset, troubled debt restructuring, charge-off, past due, classified loan. But behind each term was something concrete. A borrower was not paying, a building was not earning, a project was not worth what the thrift said it was worth. The institution had turned deposits into promises, and now the promises were breaking. There were also cases where the problem was not only foolishness, but fraud. This matters because the savings and loan crisis was not merely a case study in interest rates and deregulation. It was also a period of major financial crime investigations. In 1990, GAO reported that 7,097 financial institution fraud investigations were underway, and 3,027 of those were major investigations involving potential losses of $100,000 or more at banks, thrifts, and credit unions. Those numbers give the crisis a different texture. They remind us that behind the broad economic forces were individual choices, forged documents, false statements, insider benefits, hidden conflicts, and deals arranged so that the gains could be private while the losses moved outward. Fraud in a thrift did not always look like a man stealing cash from a drawer. It could be quieter than that. It could be a knowingly inflated appraisal. It could be a loan made to a related party without proper disclosure. It could be a borrower misrepresenting financial strength. It could be a manager hiding the true condition of assets. It could be securities sold to customers who did not understand the difference between an insured deposit and a risky investment. It could be a set of transactions that looked legal one by one but formed an abusive pattern when placed together. The most effective financial misconduct often wears a suit and carries a folder. It knows the vocabulary. It knows how to sound legitimate. This is why the phrase bad loans is both accurate and incomplete. A bad loan can be bad because the economy turned. A bad loan can be bad because the lender misjudged risk. A bad loan can be bad because the borrower lied. A bad loan can be bad because insiders wanted it made no matter what. In the failed thrifts, all these types could exist side by side. That made cleanup difficult. Regulators and later resolution officials had to separate what could be sold from what had to be written down, what was recoverable from what was gone, what was merely foolish from what deserved prosecution. Every file demanded judgment. Every judgment had a cost. For ordinary employees, the final days could be humiliating and frightening. A thrift office is not a dramatic place until the day official control changes. Then everything ordinary becomes tense. People wonder whether they still have jobs. Customers call constantly. The local newspaper sends a reporter. Security may appear. Government officials arrive with instructions. Signs may be changed. Accounts may be transferred. Some employees are told to continue serving customers as calmly as possible, because panic helps no one. Others are asked to help locate records or explain systems. The institution that had once presented itself as a permanent part of the community becomes a case to be handled. Customers experience the failure in uneven ways. Insured depositors were generally protected up to the legal limit, and that protection mattered enormously. A retiree with insured savings might be made whole even if the thrift itself collapsed. But being protected is not the same as being untouched. People still felt fear. They had to ask whether their accounts qualified. They had to understand limits, account categories, ownership rules, and timing. Some had deposits above insured limits. Some had purchased uninsured products they believed were safe because they bought them inside a savings institution. Some had mortgages or business relationships now caught in a failed institution's clean-up. Even when the government made depositors whole, trust did not simply reset itself. You can replace money more easily than confidence. There is a particular scene that repeated itself in different forms across the country. A customer stands in a lobby asking a question the teller cannot fully answer. Is my money safe? Will my cheque clear? What happens to my certificate? Who owns my loan now? The teller may have a printed statement. The manager may have been instructed what to say. The answer may be technically reassuring. But the customer is really asking a larger question. How could this place fail when it looked safe yesterday? That is the emotional centre of the crisis. The visible world and the hidden world no longer matched. The building had promised solidity. The books had held decay. By the late 1980s, the federal system built to insure and supervise thrifts had been overwhelmed. The Federal Savings and Loan Insurance Corporation, which was supposed to stand behind thrift deposits, had become unable to cover the scale of failures. GAO warned in early 1989 that the deposit insurance system needed stronger authority over improperly operated and undercapitalized institutions, along with sufficient funds to finance resolutions. That warning says a great deal about the stage the crisis had reached. This was no longer a matter of quietly supervising a few troubled firms. It was a question of how to protect the integrity of the entire insurance promise. The guarantee that had reassured savers now required rescue itself. Inside failed thrifts, the clean-up often revealed how much had been hidden by delay. Assets were not worth what they had been carried for. Loans that looked collectible were not. Real estate that seemed valuable was difficult to sell. Buyers demanded discounts. Some assets had to be auctioned. Others had to be managed, packaged, or held because dumping them all at once could damage already weak local markets. The government was not simply closing banks. It was inheriting an enormous pile of troubled assets and trying to convert them back into cash without making the losses worse. Later, the Resolution Trust Corporation would resolve 747 institutions and dispose of hundreds of billions of dollars in assets through sales, auctions, securitizations, and partnerships. But before that machinery could operate, someone had to face the ugly first moment when the institution's public face finally gave way to its real condition. There is something almost sad about an empty bank office after failure. The furniture remains, the desks remain, the vault remains, the little rooms where people once discussed mortgages remain. But the meaning has gone out of the place. A bank lobby without trust is just a room with counters. The calendars on the walls suddenly look foolish. The candy bowl looks like a prop from another era. The framed slogan about community service feels embarrassing. The office may be clean, but it is no longer reassuring. People do not lower their voices because they respect the institution. They lower them because something has died there. For communities, a failed thrift could also reveal how deeply finance had been woven into local identity. The savings and loan may have sponsored Little League teams. Its president may have served on civic boards. Its advertisements may have appeared in church bulletins, school yearbooks, and local newspapers. It may have financed homes for people who still lived nearby. When such an institution failed, the story was not only financial, it became social. People asked who knew what. They asked whether the board had been asleep. They asked whether regulators had been too slow. They asked why the people who benefited from the risky years seemed to leave before the bill arrived. In some places, failure produced shame as much as anger, because the thrift had been part of the town's own image of responsibility. The anger sharpened when people learned that some insiders had profited while institutions were weakening. Even when no crime had occurred, large salaries, fees, bonuses, and related party gains looked obscene beside public losses. A thrift could fail and leave taxpayers to absorb damage while some of the men connected to its growth had already taken their money out in legitimate-looking ways. That is one of the hardest things for ordinary people to forgive in financial crises. Not simply that mistakes were made, but that the people closest to the mistakes often seemed best positioned to escape them. Still, it would be too easy to make every failed thrift look like a den of thieves. The more difficult truth is that failure came from layers: macroeconomic shock, deregulation, weak capital, poor supervision, regional real estate busts, fraud, political delay, human optimism, human greed, human fear. The crisis was not one sin. It was a system that allowed many different sins and weaknesses to reinforce one another. That is why it became so expensive and so hard to stop. One failed institution could be closed. Hundreds required a new national response. By the time the closures accumulated, trust had vanished not only from individual offices but from the broader idea that the thrift industry could regulate itself or be managed under the old framework. Congress finally acted in 1989 with the Financial Institutions Reform, Recovery and Enforcement Act, which abolished the old Federal Home Loan Bank Board and the bankrupt FSLIC, created the Office of Thrift Supervision, placed thrift insurance under the FDIC, and established the Resolution Trust Corporation to resolve troubled S and Ls. That law belonged to the next stage of the story, but its arrival tells us what the failed thrifts had already proven. The old system could not repair itself from inside the same walls where the damage had grown. So picture that failed thrift one last time before we leave it. The branch is open, but not as it was. Customers come in with folded documents. Employees answer questions carefully. Government officials review files. The loans that once looked like assets are being sorted into categories no advertisement ever mentioned. The good ones may be sold. The weak ones may be discounted. The hopeless ones will become part of the public cost. Outside, life continues with a strange indifference. Traffic passes. Someone buys groceries. A child waits for a school bus. But inside that office, the old promise is broken. The promise that a place called savings would be careful. The promise that home finance would stay close to home. The promise that respectable buildings contained respectable numbers. And when enough of those promises broke, the story could no longer remain inside the failed thrifts. It moved to Washington, to hearings, to emergency legislation, to the creation of a cleanup agency, to taxpayers who had never approved a speculative loan but would now help pay for one, and to a public anger that came from realizing that the safest-looking money in America had been used in ways ordinary Americans would never have accepted if anyone had explained the risks clearly while there was still time to stop them. By the time the bill reached Washington, the damage had already travelled through too many places to be kept quiet. It had moved through loan files and empty office parks, through unfinished condominiums and closed branch doors, through frightened depositors and angry employees, through regulators who knew the numbers could no longer be massaged into health. What had begun as a problem inside a specialised corner of American finance had become a public emergency. The old savings and loan system had been built around modesty, around small savers and home mortgages, around the quiet belief that thrift meant caution. Now the country was being asked to pay for a disaster created in institutions that had carried the word savings on their signs, while some of them behaved as if insured deposits were chips on a table. There is something very difficult for people to accept when a financial bailout arrives. The argument for it may be practical. It may even be correct. Officials can explain that depositors must be protected, that confidence must be preserved, that the payment system must remain stable, that letting the whole thing collapse would cost more than rescuing it. Those arguments matter. They are not imaginary. But public anger does not begin in a spreadsheet. It begins with a simpler question. Why am I paying for something I did not do? A teacher in Ohio did not approve a speculative land loan in Texas. A nurse in Pennsylvania did not inflate an appraisal in California. A factory worker in Michigan did not lobby Congress for looser rules. A retired couple in Florida did not decide to keep insolvent thrifts open while losses grew. Yet when the system failed, the bill did not remain with the people who had made the worst decisions. It moved outward, into federal funds, into public debt, into taxpayers' lives, into the national memory. That was the emotional centre of the bailout. The government had promised insured depositors that their money would be safe, and that promise could not simply be abandoned because thrift managers, developers, regulators, and lawmakers had created a mess. If the guarantee failed, every saver in the country would have learned that federal deposit insurance was not really a promise at all, only a hope. So the government had to act. It had to protect ordinary depositors, close failed institutions, sell assets, reorganise oversight, and clean up an industry that could no longer clean up itself. In 1989, Congress passed the Financial Institutions Reform, Recovery and Enforcement Act, known as FREIA, which abolished the old Federal Home Loan Bank Board and the insolvent Federal Savings and Loan Insurance Corporation, created the Office of Thrift Supervision, placed thrift insurance under the FDIC, and established the Resolution Trust Corporation to resolve failed thrifts. That law sounds like a collection of agencies and acronyms, but in real life it meant the country was admitting the old system had failed. FFSLIC, the insurance fund that was supposed to protect savings and loan deposits, had itself become part of the disaster. The insurer needed rescue because the insured institutions had produced losses beyond what it could bear. That is a strange and unsettling moment in any financial system. The safety net tears, and then the public has to pay to repair both the fall and the net. FIRREA was not just a reform law, it was a public confession that the thrift crisis had become too large for ordinary supervision, too costly for quiet handling, and too politically explosive to leave inside the old agencies. The Resolution Trust Corporation, the RTC, became the government's great clean-up machine. Its job was not elegant. It did not exist to dream up new communities or finance first homes or welcome depositors with passbooks. It existed to take over the wreckage. It closed, merged, sold, managed and liquidated failed savings and loans. It inherited bad loans, real estate, half-finished projects, office buildings, land, mortgages, and assets whose official values often had little to do with what buyers would actually pay. Imagine a vast national estate sale after a decade of reckless lending, except the estate was scattered across the country, the paperwork was tangled, the assets were deteriorating, and every delay could make the bill worse. That was the RTC's world. The Federal Reserve's history records that the RTC ultimately resolved 747 failed thrifts with more than $407 billion in assets. Those numbers are so large they almost flatten the human story, so bring them down to a room. Picture a warehouse of file boxes. Each box contains loans that once had names attached to them. Borrowers, officers, appraisers, projects, addresses. One file leads to a half-empty shopping centre. Another to land outside a growing city that stopped growing fast enough. Another to a condominium building that could not be sold for anything close to its loan value. Another to a mortgage still performing and useful. The clean-up required sorting all of it. What could be sold? What had to be written down? What might recover value if held? What was worth almost nothing? The government had to become, for a time, one of the largest handlers of distressed real estate and troubled financial assets in the country. And the country watched with a mixture of confusion and resentment. The language was complicated. FSLIC, FIRREA, RTC, RFCORP, conservatorship, receivership, asset disposition, resolution costs. The ordinary person hearing these words on television might not understand every mechanism, but they understood the direction of the money. It was going from the public to cover losses borne in private institutions. The FDIC's own history later estimated the total direct and indirect cost of resolving the savings and loan crisis at $160.1 billion, including funds from taxpayers and from the thrift industry, while other widely cited estimates placed the direct taxpayer cost around $124 billion. There is a particular bitterness in the word bailout. It sounds like water being thrown out of a sinking boat. It sounds urgent, physical, necessary. But it also sounds like someone else drilled the hole. That was why Americans were angry. Many of them understood that insured depositors had to be protected. They understood, at least in broad terms, that a collapse of confidence could be dangerous. But they did not understand why so many people who had profited in the reckless years seemed to avoid the deepest pain. They saw developers who had taken fees, executives who had drawn salaries, insiders who had benefited from transactions, political figures who had accepted contributions, and regulators who had been too slow. Then they saw taxpayers asked to make the system whole. It did not feel like rescue. It felt like cleanup after a party most Americans had never been invited to. The anger had faces, and one of the most famous belonged to Charles Keating and Lincoln Savings and Loan. Lincoln became a symbol because it brought together so many public fears at once. Aggressive thrift management, political influence, ordinary investors harmed, and the sense that regulators had been pressured or delayed. The FDIC's archived materials on Charles Keating and Lincoln Savings point to the Senate ethics inquiry into Senators Cranston, DeConcini, Glenn, McCain, and Regal and Lincoln Savings, a case that became known nationally as the Keating 5 scandal. The story fed a suspicion that the crisis was not merely about bad loans, but about access. Who could call whom? Who could slow down an examiner? Who could get a meeting? Who could turn financial weakness into political pressure? That suspicion mattered because financial crises often become political crises when people believe the rules were not the same for everyone. A small borrower missing mortgage payments could lose a house. A thrift executive could oversee enormous losses and still hire lawyers. A family with too much money in the wrong uninsured product could be wiped out. A politically connected developer might have had years of credit extended before anyone forced reality into the room. Whether every suspicion was fair in every case is not the point. The larger damage was that the public began to believe the system had protected the powerful longer than it protected the prudent. There were hearings, there were investigations. There were statements of outrage from members of Congress who now had to explain why the public had been left with such an enormous cost. There were officials promising tougher enforcement, better supervision, stronger capital rules, and a different future. But hearings have a strange limitation. They can expose a story, but they cannot undo it. By the time the cameras are on and the witnesses are sworn, the money is often already gone. A hearing can ask why a loan was made, why a warning was ignored, why a regulator waited, why a campaign contribution looked too convenient, why an institution was allowed to keep growing. Those are necessary questions. But the half-built building does not become occupied because the questions are asked. The bad loan does not become good because someone says, "I do not recall." The taxpayer does not get excused from the bill because the anger is justified. The criminal investigations also became part of the public reckoning. Fraud had not caused every thrift failure, but fraud and insider abuse were significant pieces of the crisis. GAO reported in 1990 that thousands of financial institution fraud investigations were underway, including major investigations involving banks, thrifts, and credit unions. That matters because it tells us the bailout was not only covering honest mistakes made in a difficult economy, it was also cleaning up after misconduct, deception, and abuse in some institutions. For ordinary Americans, that distinction sharpened the resentment. Losing money because interest rates changed is painful. Losing money because people lied, looted, or looked away is harder to forgive. Still, the bailout had to proceed because the alternative was not simple justice, it was disorder. The government could not say to insured depositors, "Sorry, the insurance fund is broke." It could not allow uncertainty to spread across the financial system. It could not leave hundreds of failed or failing institutions in limbo indefinitely. The RTC had to sell assets, arrange deals, protect depositors, and close institutions in a way that did not create even more panic. In public, this looked like Washington rescuing bankers. In the machinery of government, it was often a grim administrative task. Value the assets, find buyers, absorb losses, move accounts, close offices, preserve records, pursue recoveries, and try to prevent the damage from spreading. The RTC's work was not always smooth. It faced criticism over costs, staffing, contractor fees, asset sales, and the pace of cleanup. GAO's work on the RTC in the early 1990s examined its funding needs, asset disposition, and management problems, showing how difficult the cleanup became once the government inherited such a large and messy pile of failed institution assets. This was not like closing a single failed bank in a weekend and opening it under a new name on Monday. It was a national disposal operation, and every sale raised questions. Sell too quickly, and the government might accept low prices. Wait too long, and maintenance costs, market risk, and political criticism increased. Hold assets, and taxpayers worried the government was becoming a landlord of bad decisions. Auction assets, and people wondered who was buying them cheaply. That last point became another source of anger. In any clean-up, someone buys the wreckage. Investors with cash and patience can purchase distressed assets at discounts. Some of them profit later. That is part of how markets clear bad assets. But to the public, it can look like a second unfairness. First, taxpayers cover the losses. Then well-positioned buyers acquire assets cheaply from the government. The average citizen, who helped fund the rescue indirectly, does not get to walk into an RTC auction and buy a package of commercial loans. He does not have the information, the capital, or the access. So even the necessary act of selling assets can feel like another transfer from ordinary people to those who know how to operate inside crisis. For employees of failed thrifts, the bailout was not abstract either. Some lost jobs, some watched institutions they had served for years vanish into mergers or liquidation. Many had done nothing wrong. They had processed deposits, answered phones, handled paperwork, and believed their employers were legitimate. A bailout does not protect everyone equally. Depositors may be made whole. Executives may fight in court. Taxpayers may pay over time. But the branch worker may simply be unemployed. The crisis scattered pain unevenly, which is one reason it left such a sour taste. The people least responsible were often the easiest to replace. The same was true for communities. A failed thrift could leave behind more than a closed office. It could leave stalled developments, unfinished roads, vacant commercial space, and a weakened local real estate market. If too many lenders had funded too many projects, the cleanup could depress prices further. The RTC had to dispose of assets, without flooding markets so badly that recoveries became worse. A town that had been told it was growing might discover that some of its growth had been borrowed from a fantasy. The buildings remained, but the story behind them changed. A new shopping centre once advertised as progress became evidence. An empty office park became a lesson in overbuilding. A subdivision with too few houses became a map of misplaced confidence. And then there was the ordinary taxpayer who experienced the bailout mostly as a distant burden. No one sent a bill marked, "Your share of the failed thrift down the road." That is not how federal costs usually arrive. They move through appropriations, debt, taxes, interest, budgets, and years. That can make the burden feel invisible, which is politically convenient, but invisibility does not mean absence. Public money spent cleaning up the thrift crisis was public money not available for other uses, or money added to obligations future taxpayers would carry. The cost did not arrive like a single knock at the door. It arrived as part of the background weight of government finance. What made people furious was the asymmetry. During the boom, gains had been private and specific. A developer got financing, an executive earned compensation, an insider benefited from a transaction, a politically connected figure received support, a broker placed deposits, a speculative project got funded. But when the losses came, they became public and general. That is the pattern that angers people across generations because it violates a basic instinct for fairness. If you take the risk, you should bear the loss. If you take the profit, you should not hand the wreckage to someone else. The savings and loan crisis exposed how easily that moral rule can break when public guarantees support private institutions without enough restraint. There is no way to tell this part of the story honestly without saying that the bailout also worked in certain practical ways. The government did protect insured depositors. It did close hundreds of failed institutions. It did create a mechanism for disposing of assets. It did reform thrift supervision and restructure deposit insurance. The financial system did not collapse into depression-style chaos. That matters. History is not made cleaner by pretending every bailout is useless just because it is infuriating. Sometimes a bailout is both necessary and enraging. Sometimes the responsible thing at the end is to pay for the irresponsible things that should have been stopped earlier. That is what makes the politics so poisonous. The people paying for stability are often the same people who were never allowed to profit from instability. FIRREA also tried to make the future different. It imposed stricter capital standards, strengthened enforcement, reorganised thrift regulation, and tried to restore discipline to an industry that had stretched the word thrift almost beyond recognition. The law's full name included reform, recovery, and enforcement for a reason. It was not only about money, it was about authority. It was about giving regulators more power to act, pursue wrongdoing, and prevent thinly capitalised institutions from using insured deposits in reckless ways. But laws passed after disaster always carry a shadow. They show what people finally understood too late. I keep thinking about the ordinary saver in this part of the story, not the speculator, not the executive, not the senator, just the person who believed a savings institution would behave like a savings institution. Maybe she had lived through enough of the 20th century to distrust risk. Maybe she liked the passbook because it gave her numbers she could see. Maybe she chose a certificate of deposit because it sounded safe, sensible, adult. She did not know about capital forbearance. She did not know about brokered deposits. She did not know about speculative development loans. She did not know whether FSLIC had enough money. She trusted the structure around her. And when that structure failed, officials told her the insured portion would be protected, which was true and important. But the deeper reassurance was gone. She had learned that the name on the building did not tell the whole story. That lesson spread beyond the thrift industry. Americans began to understand, or at least feel, that financial safety depends on rules most people never see. It depends on capital requirements, examiner authority, honest appraisals, limits on insider dealing, prompt closure of insolvent institutions, and political willingness to act before the bill becomes unbearable. None of these things are sentimental. None make good lobby posters. They do not feel as warm as a local bank lobby or as inspiring as a ribbon cutting, but they are part of what protects the savings of people who will never attend a board meeting. When those safeguards weaken, ordinary people may not notice immediately. They notice later, when the cost has already found them. The anger eventually settled, as public anger often does, not because the injustice disappeared, but because new crises arrived. The RTC wound down, failed thrifts were sold or closed, assets were disposed of. The industry shrank and changed, the headlines moved on, but the savings and loan crisis left behind a memory that would matter later whenever Americans heard that financial institutions were too important to fail, or that government money had to be used to stabilize a system, or that complex risks had been misunderstood by people paid very well to understand them. The details would change in later crises, but the old question would return. Why are ordinary people paying for risks they did not choose? By the end of the clean-up, the bank on the corner was no longer the same symbol it had once been. Some thrift survived. Some behaved honourably. Some continued serving communities. But the innocence of the old image was gone. The country had seen what could happen when a protected institution was allowed to chase unprotected dreams. It had seen how long failure could be hidden behind polite counters and official language. It had seen how expensive delay could become. And it had seen that when the bill finally came due, it did not arrive only for the men who had made the deals. It arrived for the public. The bailout closed one part of the story, but it opened another. Because once the money was spent, once the assets were sold, once the hearings ended and the agencies changed their names, Americans were left with the harder question of what the crisis had changed. Not just in law, not just in banking regulation, but in the way people understood trust itself. The savings and loan crisis forced the country to ask what a safe bank really is, what deposit insurance can and cannot do, how much freedom financial institutions should have when the public stands behind them, and why the word thrift, once so plain and respectable, had come to carry the memory of one of the costliest financial failures in American history. The crisis changed banking in the same way a house fire changes the way a family looks at a candle. Not because candles become evil, not because warmth becomes suspicious, not because every ordinary flame must be feared, but because once you have watched something familiar nearly destroy the place it was supposed to comfort, you never again treat it as harmless simply because it looks small. Before the savings and loan crisis, Americans had been taught to think of certain financial institutions as almost domestic objects. A thrift was not a trading floor. It was not a Wall Street partnership. It was not a place for speculation and exotic ambition. It was the savings office, the mortgage office, the modest building where respectable people put money away and borrowed carefully for homes. After the crisis, that innocence was gone. The country had learned that a small institution could still create enormous danger if the rules around it were weak, if the people supervising it waited too long, if public insurance protected deposits but did not restrain managers, and if a word like savings remained painted on the door after the business inside had become something else. The first thing the crisis changed was the old thrift world itself. It did not disappear overnight, but it never regained the same meaning. The savings and loan had once been one of the main roads into American homeownership. At their height, savings institutions originated 2/3 of the nation's home mortgages, and that old housing mission had given them a special place in the financial system, OCC.gov. But after the crisis, the old specialized thrift seemed less like a beloved local tool and more like a cautionary relic. Too many of them had reached beyond home lending into land deals, commercial real estate, speculative construction, and insider relationships they were not prepared to handle. The public did not need to understand every detail to feel the change. The word thrift had been bruised. It still meant savings in the dictionary, but in the national memory it now also meant bailout, fraud, collapse, and the discovery that the small safe bank could be used badly. Washington's first answer was structural. The government did not merely patch the old system and send it back into the world as if nothing had happened. In 1989, the Financial Institutions Reform, Recovery and Enforcement Act abolished the Federal Home Loan Bank Board and the insolvent Federal Savings and Loan Insurance Corporation, created the Office of Thrift Supervision, placed thrift insurance under the FDIC, and established the Resolution Trust Corporation to resolve failed institutions. FederalReserveHistory.org. Those changes sound administrative, and in one sense they were. Agencies were ended, new offices were created, powers were moved. But behind the acronyms was a national judgment. The old guardians had failed. The agency that was supposed to ensure thrift deposits had itself become unable to bear the cost. The system that had allowed weak institutions to keep operating had lost the right to continue unchanged. There is something almost severe about the abolition of an agency. People often talk about government offices as if they are permanent fixtures, dull and immovable, but the savings and loan crisis showed that institutions designed to oversee finance can also be judged by history and replaced. FSLIC did not simply run out of money, it ran out of credibility. The Federal Home Loan Bank Board did not simply oversee an industry through a difficult period. It became associated with delay, forbearance, and a supervisory framework built for a simpler business than the one deregulation had created. So the old structure was dismantled. That dismantling was a message to the financial world. If a regulatory system cannot stop insured institutions from gambling themselves into public rescue, then the system itself becomes part of the failure. The Resolution Trust Corporation was another change, not only because of what it did, but because of what it revealed. The RTC was built as a clean-up agency, a temporary machine for a disaster that had become too large for ordinary tools. It closed and resolved 747 savings and loans with more than $407 billion in assets before it finally shut down at the end of 1995, and the ultimate taxpayer cost has been estimated as high as $124 billion. FederalReserveHistory.org. That experience left a permanent lesson. When financial failures are allowed to grow too large, the cleanup becomes its own industry. The government does not merely close doors and write checks. It inherits assets. It manages real estate. It sells loans. It hires contractors. It creates procedures for disposing of the physical remains of bad credit. The failed thrift is not gone when the sign comes down. Its consequences have to be sorted, valued, auctioned, litigated, written off, and explained. For banking, that meant failure resolution became a subject of deeper seriousness. It was no longer enough to assume that troubled institutions could be handled quietly after the fact. The country had seen how expensive after the fact could become. A bad institution left open is not neutral. It can keep attracting insured money. It can keep making loans. It can keep growing. It can turn a manageable loss into a public burden. This savings and loan crisis forced regulators and lawmakers to think harder about prompt intervention, capital standards, and the danger of letting hope take the place of closure. In finance, waiting can feel merciful, but the crisis proved that waiting can also be a subsidy to denial. Capital became one of the great lessons. Before the crisis, too many weak thrifts were allowed to operate with too little real cushion. Capital sounds like a cold technical word, but it has a moral function inside banking. It is the owner's stake, the money that absorbs losses before depositors, insurance funds and taxpayers do. When an institution has enough capital, the people who control it have something meaningful to lose. When it has almost none, risk begins to look different. The upside can still be private. The downside begins moving toward the public. The savings and loan crisis made that danger impossible to ignore. It taught the country that a bank or thrift without enough capital is not just weak. Under the wrong incentives, it can become reckless, precisely because it is weak. That lesson helped shape later thinking about prompt corrective action. The idea that regulators should be required to intervene as an institution's capital deteriorates rather than waiting until collapse is undeniable. The details would be refined through later legislation and regulation, but the deeper memory came from the thrift disaster. Do not let insolvent or nearly insolvent institutions gamble for resurrection. GAO's later work on bank regulation described prompt corrective action as one of the post-crisis tools intended to make regulators act earlier when capital problems emerge, reflecting lessons drawn from earlier banking failures. GAO.gov. That phrase, gamble for resurrection, may sound dramatic, but it is exactly the danger. A dying institution can become more dangerous than a healthy one because it may see prudence as pointless. The crisis made regulators more alert to that ugly moment when an institution stops managing risk and starts betting that one large win will erase all the earlier losses. Deposit insurance also changed in meaning. It remained essential. The crisis did not prove that deposit insurance was a mistake. Quite the opposite. It protected ordinary savers and prevented the kind of panic that had scarred the 1930s. But it also showed that insurance can create moral hazard if it is not paired with strong supervision. Insured depositors do not have to police the institution closely, and that is the whole point. A school teacher or retiree should not need to become a bank examiner to decide where to place insured savings. But if depositors are relieved of that burden, regulators must carry it with real discipline. The crisis revealed what happens when the public guarantee is strong enough to attract money, but the supervision is not strong enough to restrain how that money is used. That changed the way serious people talked about safety. Before the crisis, safety often meant reassurance. The deposit is insured, the institution is chartered, the building is official. After the crisis, safety had to mean something more demanding. Is the institution well capitalized? Are its assets sound? Are insiders restrained? Are appraisals credible? Are regulators independent and properly funded? Are failures recognized early? Are managers punished when they abuse public guarantees? The word safe had to become less sentimental and more mechanical. It no longer belonged only to the sign in the lobby. It belonged to examiners, capital ratios, enforcement actions, loan loss reserves, and all the unromantic tools that protect people precisely because most people never see them. Real estate lending changed too, at least in the way people understood its danger. The thrift crisis showed that loans secured by land and buildings can still be deeply unsafe if the values are inflated. The borrower lacks real equity, the market is overbuilt, or the institution has incentives to ignore warning signs. Real estate had always felt solid to Americans. It was the house, the lot, the office tower, the shopping centre, the thing you could stand in front of and photograph. But the crisis revealed that a building can be both physically solid and financially hollow. A condominium unit can have walls and still be worth less than the debt used to create it. A shopping centre can have a roof and still produce no income. A piece of land can be appraised into a fantasy and then sold back into reality at a ruinous discount. This changed the role of appraisals and underwriting in the public imagination of regulation. People learned that the value attached to collateral is not handed down from heaven. It is estimated by human beings under human pressures. If those estimates are too optimistic, corrupt, careless, or based on a market that is already overheated, the entire loan can become a trap. FIRREA included reforms affecting real estate appraisal standards, a sign that lawmakers understood how deeply bad valuation practices had contributed to the crisis. FederalReserveHistory.org. The lesson was plain enough for anyone to understand. A loan is only as safe as the truth beneath it. If the collateral value is imaginary, the safety is imaginary too. Another permanent change was the suspicion of rapid growth. Before the crisis, growth often sounded like proof of success. A thrift that doubled its assets could boast of expansion, ambition, confidence, and market share. After the crisis, rapid growth in a financial institution looked more complicated. Where did the money come from? Was it local and stable or brokered and expensive? What kinds of loans were being made with it? Did management have experience in the new business lines? Was the growth supported by capital, or was it a desperate attempt to outrun losses? The Federal Reserve's account of the crisis notes that thrift assets grew 56% from 1982 to 1985, more than twice the growth rate of commercial banks, as deposits flowed into weak institutions willing to pay high rates. federalreservehistory.org. That one statistic became a warning in disguise. Fast growth is not always vitality. Sometimes it is fever. The industry's public identity also changed because the crisis blurred the distinction between local banking and national consequences. The old thrift seemed local. It took deposits here and made loans here. But by the 1980s, brokered deposits, federal insurance, regional real estate speculation, and national policy choices meant that a bad thrift could draw money from far away and send losses back to the public at large. A local institution was no longer merely local once it was plugged into insured national funding and deregulated powers. That changed how Americans had to think about community finance. The friendly lobby might be local, the risk might not be. The crisis also left a political lesson about deregulation. It did not prove that every regulation is wise, or that every old rule should remain forever. History is rarely that simple. The old thrift system really had been under pressure from inflation, high interest rates, and changing financial markets. The restrictions around it were no longer working neatly. But the crisis did show that deregulation without adequate capital, supervision, and enforcement can be a dangerous bargain. Removing old limits may be necessary in some circumstances, but if public insurance remains in place, freedom must be matched by discipline. You cannot tell an insured institution to compete like a risk-taking market player while allowing its losses to be socialized like a public utility. That contradiction was one of the central failures of the 1980s thrift experiment. There was also a lesson about political influence, and it was not a comforting one. The crisis showed that financial institutions in trouble do not simply wait passively for regulators. They lobby, they call, they cultivate relationships, they frame supervision as hostility, delay as fairness, and enforcement as overreach. The Keating 5 scandal became the most famous political symbol of that danger, but the broader issue was larger than one case. When regulators try to act against a powerful or connected institution, political pressure can become part of the balance sheet. It does not appear as an asset or liability, but it can delay action, intimidate examiners, and make public servants wonder whether doing their jobs will turn into a public fight. The crisis made clear that bank supervision must be insulated from that pressure as much as possible, because the cost of delay does not stay in Washington. It lands on the public. And then there was the longer afterlife of the Office of Thrift Supervision itself. FIRIA created the OTS in 1989 as part of the answer to the crisis, but even that answer did not last forever. After the financial crisis of 2008, Congress passed Dodd-Frank, and the OTS was abolished, with its functions transferred to the OCC, FDIC, Federal Reserve, and Consumer Bureau in 2011. OCC.gov. That later development belongs to another story, but it tells us something important about the savings and loan legacy. The crisis did not produce a perfect regulatory structure that stood unchanged for generations. It produced lessons, and those lessons had to be relearned, revised, and argued over as finance changed again. Regulation is not a monument. It is more like a roof in bad weather. It has to be maintained, inspected, repaired, and sometimes rebuilt after the storm proves where the weaknesses were. For ordinary Americans, the most permanent change may have been psychological. The crisis taught people that safety is not always visible. A bank can look calm while its loans are rotten, A lobby can look respectable while insiders are extracting value. A government guarantee can protect a depositor while also enabling managers to take risks they should never have taken. A financial institution can use familiar words while performing unfamiliar acts. This is a hard lesson, because modern life requires trust. You cannot personally inspect every institution that touches your money. You cannot review every loan file behind your savings account. You cannot sit in every board meeting or read every examiner's report. You have to rely on systems, and when those systems fail, the betrayal feels larger than money. That is why the savings and loan crisis still matters, even though many of its buildings are gone and many of its acronyms have faded. It revealed a pattern that would return in different forms. Private institutions take risks under public protection. Regulators see danger but act too slowly. Financial products appear safe because of where they are sold or who stands behind them. Real estate values rise until everyone forgets they can fall. Growth is mistaken for health. Complexity outpaces supervision. The profits are counted quickly, the losses slowly. Then the public is told that rescue is necessary because the alternative would be worse. The details change, the feeling does not. And yet there is another side to the legacy. Quieter, but important. The crisis did not destroy deposit insurance. It did not end home lending. It did not make every banker dishonest or every financial institution unsafe. It forced the country to become more sober about what safety requires. It taught that boring rules are not always enemies of progress. Sometimes they are the only reason ordinary people can sleep without wondering whether the savings account is being used to finance somebody's fantasy. It taught that examiners matter, that capital matters, that early intervention matters, that the word insured must be treated with respect because it carries the public behind it. It taught that thrift, as a virtue, cannot survive if the institutions bearing its name forget restraint. So when you pass a bank today, or open an account, or see an advertisement promising security, the savings and loan crisis sits somewhere behind that ordinary moment, even if no one names it. It sits in the rules about capital. It sits in the way regulators think about failing institutions. It sits in the suspicion of rapid growth funded by hot money. It sits in the memory of empty developments and bad loans. It sits in the understanding that a financial institution is not safe because it looks safe, or because its name is comforting, or because it has been there for years. It is safe only if the promises inside it are backed by real assets, honest management, sufficient capital, careful supervision, and a willingness to stop trouble while it is still small enough to stop. The old savings and loan had once promised a simple American bargain. Save carefully, borrow carefully, buy a home, build a life. For many families that bargain was real, and it helped shape the country. But in the 1980s, too many institutions stretched that bargain until it broke. They took the language of thrift and attached it to speculation. They took public insurance and used it to attract private money into risky deals. They took trust, the quietest and most valuable asset in banking, and spent it as if it could always be printed again. It could not. And maybe that is where the story leaves us. Not with an empty bank lobby or a government balance sheet, but with the fragile thing that every financial system needs and every financial crisis damages: trust. The kind of trust that lets a person deposit a paycheck and go home without fear. The kind that lets a family sign a mortgage and believe the institution across the desk will still be there next year. The kind that lets a country build ordinary life on promises most people never read in full. The savings and loan crisis changed banking forever, because it showed how easily that trust can be used, how expensive it is to repair, and how dangerous it becomes when the people entrusted with savings forget that someone else worked for every dollar they are risking.